And it's now Biden's plan had talked about eliminating this. That's pretty progressive. I can't envision a universe where this would get eliminated, especially with, it looks like the Republicans are going to hold the Senate. Actually, if you think about it, historically, the most fiscally responsible government we had was Democrat Clinton with Republican House and Senate. They checked each other up. That's the last time we had a surplus. So I actually would not like to see, I hope the Republicans hold the Senate, because that'll temper the whole thing. And ironically, in this country, less legislation is usually better at this point. So anyway, so I don't think this is going away, but this is a fantastic tax benefit, especially if you're doing real estate on the side. Now, on your own house, on your personal residence, what is it, like 200 and 400,000 for 250 and 5. So if you're single, you lived in it for 3 of the last 5 years, 2 of the last 5, then you don't 250. If it's 500,000 for a couple, then you don't pay tax either. More than that, you would pay long-term capital gains on that. And I didn't understand this when I got started, but if you if you flip a property in less than 1 year, those profits plus whatever you earn at your job, you're paying that tax rate. It's just like if you do a Roth conversion. So if you made $100,000 a year at your job, you make $100,000 on a flip, you're paying tax at the $200,000 tax bracket. That's how it works. You go longer, well, then there's tiers for longer term capital gains. But you can completely defer the tax with a 1031 exchange. So imagine buying a property for $100K, you sell for $200K, you don't want to pay the $100,000 in taxes. All you got to do is buy $200,000 in something real estate. Now, it doesn't have to be the same kind of asset class. So if you sold raw land, you don't have to reinvest in raw land. You can go from raw land to 3 houses. You can go from raw land to an apartment complex. You can go from an apartment complex to raw land. It just has to be real estate. That's what they mean by like kind. And so, but a lot of people don't understand. They think, all right, well, I have $100,000 in profit. I just need to reinvest $100,000. That's not right. You got to invest the whole sales price to get a complete deferment. The problem is that a lot of people will end up buying a crappy property just to finish the exchange when you would have been better just probably paying partial tax. Sometimes, now if you have a mortgage on that property, then when you do the 1031, you have to maintain leverage. You have to maintain a mortgage on the reinvest side. A lot of people don't want to do that, so they'll do a partial exchange. Opportunity zones worked very similar to that. We talked about that a little bit the other day. But in both cases, it's difficult to maintain that structure. And so, not paying taxes is always a benefit, but not paying taxes at the expense of buying a lousy property is bad investing. That's the tail wagging the dog. And so you always want to make sure you're getting a good deal. Yeah.
What's the time limit to complete the exchange?
What is it, Catherine? It's like 45 days to designate, and then
180 days to close.
And then they have one extension provision, right?
I don't know about the extension, and it can be more than one property.
Yeah.
And it does not have to be in the same calendar year.
No, and so the other dynamic is you need to use a 1031 facilitator. So if you live in Seattle, for example, 1031 exchange Seattle, and there's going to be companies there that will oversee the 1031 exchange for you. Okay.
You have to identify in 45 days and complete by 90.
Yeah, is that what it is? 90? Identify 40, complete 90?
No. I thought it was identified 45 days.
I thought it was 90.
180.
It is 180? Okay. But you can see, here in Seattle, there's several services that specialize. So you want to find a regional third-party person. Now, maybe you have a property at home that you want, and we have a lot of investors who will say, hey, can you guys help me complete an exchange? We're happy to help you do that. That's something that we do for a lot of people. Or I've even had somebody say, hey, can you get me like a lot in Indianapolis for $5,000 to complete my 1031 exchange? We can help you with that. Another way that we help investors is, who needs write-offs? Who needs write-offs? Period. So let's say this weekend, let's say that house that we were looking at yesterday, the last house, for $136,000. And you don't want to buy it inside your retirement account, but you need write-offs. What if I sold you that house for $100,000, and you buy it with outside retirement money, and then at close you fund in the $36,000 as well, but on the closing statement it shows that money goes to Alpine Construction. Okay, so you're buying a house pre-rehab. Now, if I sell you that house, now that house was not done. We still have some things, some light items that we got to finish on the punch list. Okay, so it's technically still in construction phase. But you could have the fastest construction project in the United States this year, because magically $36,000 in construction could be done in 2 weeks after close, and we could have a tenant in there. Now you have a property, you have $36,000 in write-offs. So we rent that house out for $1,000 a month. If you are an active investor, who's a real estate professional that does it full time? Well, now congratulations, you got $36K that you can use to offset your income over here. You got $36K in deductions, right? But if you are, who's not an active real estate professional? It's like you got to have like 700 hours a year of real estate activity, 750 or something like that. Yeah. If you're not a real estate professional, then congratulations. Now you can use it for any other rentals you have. So if you have other passive income, you got $36,000 in write-offs that income. So let's say you have, $10,000 net in the rental account at the end of the year. You ain't paying a penny of taxes. That's tax-free income. And then you can carry it forward the next year and the next year. So you literally, if that's the only property you own, you literally will not pay a penny of tax on the rent for that property for probably 3.5 years. Is that pretty cool? Okay. So one of the conversations you could have with Meg is say, hey, we want to structure this as a pre-rehab. Now remember, if it's in your IRA and 401k, it doesn't matter, because you're not paying taxes. But for those of you who are investing outside money or who need write-offs, we can structure this for you all day long. Okay, very easily. And Meg can pick out properties for you at the end of construction. So really all you're waiting for is the last little bit of construction and then the lease period. You ever get audited? Boom, look at the HUD. That went to Alpine Construction. We got your back, okay? Great way for getting more write-offs. I've had clients who are like, I don't really, I'm more focused on multifamily, or I'm a full-time real estate professional. I don't really need your 8-cap rentals. When we show them this, they're like, actually, I might like that. That might be a nice thing. When we talk to them about 1031, that's where if you're a savvier investor, we may be able to fit. We're not trying to be everything for all of you. I know that we have some very experienced investors in the room, okay? But usually there's some way where in some capacity we can help you. We had a client here in the summer. The guy kind of does what I do. And I was like, why did you come? Like, why? He's like, I don't know, man. I just kind of wanted to see your operation. And I was like, okay. Well, I said, all right, well, he's like, yeah, with my active income, it doesn't really make sense for me to buy a property from you. And I said, all right, but there's got to be somewhere in your universe where somebody has said to you, hey, will you invest this money for me? He's like, oh, you know what? My mom, I'm in charge of investing my mother's money, and we put mom into a note. So maybe not for you, our product doesn't necessarily offer, but what if you have a sister who's been bugging you to do real estate? You got a neighbor who's been trying to, hey, when you do a deal, and you don't really want to give up a deal because that's like a 16, 18, 20 cap deal for you. Maybe you send them out here to the event. They buy a property, I'll pay you a marketing fee. I'll pay you a few $1,000s. Maybe that's how we work together. I don't have a precondition about how we work with you. I'm cool with referral. I'm cool with helping somebody in your family. I'm cool with helping you with tax. I'm cool with helping you with a 1031 exchange. You know, my number one goal this weekend was show you all the different things that we do and the ways that we can help you as investors, and then let's figure out something that makes sense for now. Johnny Appleseed mode. That's all I ever do, without trying to control how relationships flow through. And I find that it makes a very relaxed environment for you, because then you don't feel like, oh man, I didn't buy a rental from Aaron this weekend. Again, trust me, we've sold a lot of property this weekend, and Meg's got a week full of appointments this week with people who've been watching the live stream that want to look at deals as well. And so hopefully you felt that with my team, with myself. That pressure is not there. Now, one other area that I wanted to mention that was a huge benefit with the Trump tax laws is cost segregation. Now, I know, how many of you have heard cost segregation? Okay, who hasn't heard of it? Let me K through 12 it for you, because this is another really big thing. So let me use this building as an example. Now, it costs $2,000. I've seen $2,000 to $5,000 for a cost segregation study. So it usually doesn't work great on a single family home. If you want write-offs for a single family home, you're better off buying pre-rehab. But if I have a cost seg group, they're actually out of Singapore. They're out of Singapore. You know, the Singaporeans are so financial savvy, financial services. A lot of big accounting firms in the U.S. take their simple tax returns, they shoot them all over to Singapore, they do them there. They outsource it. Okay? So we have this firm in Singapore that does cost seg studies for like $1,500. So we mark it up $500. So we can do a cost seg for you for $2,000. Now, this building, I bought the lot for $50K. Okay, I bought the lot for $50K. You can't depreciate. Now, what's the timeline normally to depreciate a commercial building? It's like 39. Commercial building's 39. Now, the way it normally works is I can't depreciate the lot. I can't really depreciate the foundation. Okay. But I have $600,000 in things that I can depreciate. Now, the way it used to work for a long time was you take that $600,000, you divide it by 39 years. So you have $15,384. So let's say that I'm paying myself rent on this building. I pay myself $10,000 a month. So at the end of the year, I got $120K. With me? Now I can deduct the tax, the insurance, the maintenance. Hopefully there's no vacancy. Repairs. And let's say that I get it down to $80K. The way that it's worked before then is you have one other deduction, $15,000 for depreciation, and now you're only paying taxes on $65K. You with me? It's only a $15,000 write-off a year. But if I ever sell the building, what do I have to do? You got to pay that back. They call it recapture. You took the depreciation, you got to pay it back. Now, if you do a cost segregation study for a couple $1,000, you can say, all right, well, of that $600,000, I spent $100,000 on audio-visual equipment. I take that off this year. Boom. Now instead of 15K, I got 100K for the AV. And then you go through the whole building and you break it up. The furniture, the office furniture, obviously I can write that off. The drywall, I can write that off over a couple of years. What's cool about cost segregation is you could literally depreciate all $600,000 over 3 years if you wanted to. If I really needed a lot of write-offs, I could go 200, 200. You can almost plan it. It's so deliberate. You could sit down with a tax professional and say, man, if I could have $50,000 a year in write-offs, over the next 12 years, that'd be phenomenal. Or 100,000 over the next 6 years, that'd be phenomenal. You could depreciate out the building. Question?
How much more, from a tax perspective, in terms of preparation?
Mm-hmm.
Anderson does all of our taxes and stuff, but is there a big difference in terms of the cost for doing the cost segregation analysis and then preparing your return versus not doing that?
It doesn't impact the return because the cost seg study will then show the depreciation rate, and then you would just send that to Anderson, and then they would just take the bigger write-off. Yeah. And Circle of Trust, I think their cost seg studies are like 5K. Is that what they are? Yeah, so my Singaporean connection is more better. Now, Jed, who works with me, he's the point on this cost seg. Jed with Alpine at Gmail. Feel free to hit him up and say, Aaron mentioned cost seg. Can we do something there? Okay, Jed with Alpine at gmail.com. But do me a favor and call him Jet, because everybody calls him that. Yeah.
A couple of questions.
Yep.
So you've accelerated depreciation because they're categorized or segmented. What's the impact on recapture if you were ever to sell them?
If I took 200 this year and sell it next year, I'd pay back 200. Yeah.
Even with the 1031?
Now, if you combine cost seg with the 1031, then you can defer it indefinitely. Yeah, it's massive. 1031 eliminates the need to recapture depreciation.
And what part of the process of a new construction do you need a cost seg? And do you need a cost seg if you know what you're doing up front? Is it a backwards look? Oh, I need a cost seg, or is it a frontward? Hey, I'm going in.
It could be either, right? It could be either, because let's say you were going back to revise last year's return. Keeping in mind, I'm not a tax professional. You can tell I'm just a realist. I only know the investor perspective. So you're going to want to confirm everything. All right? But my understanding, yeah, if you're going back to revise a return, but usually it's for planning going forward, anticipating what your needs are going to be.
And you have to use a third party to separate you from that?
No, you just need to pay someone to do the cost seg study for you. Once that's done, then you kind of control how you take the depreciation. Yeah. And what was the other thing I was going to say about it? Yeah, if you plan it correctly with the 1031 exchange, then you can avoid the recapture indefinitely. That's huge.
Just a question on the pre-rehab.
Yeah.
1031. So the pre-rehab, that doesn't have to get added into the basis, or how does that work?
Yeah, it would. Your basis would be $136,000 on the house.
Right.
But you would have $36,000 in repairs, not improvements, that you could.
Right off that year. Okay.
Everything's a repair to me. I never do improvements. I mean, unless I'm completing. A perfect example of aggressive tax. So for me, the only time I class it as an improvement is if I'm finishing additional square footage. So if I'm finishing an attic, finishing a basement, adding a bonus room, that is the only time I call it an improvement. Otherwise, I go aggressive on the repair, because I've had that audited. It's so subjective.
It's semantics, isn't it?
It's whichever IRS agent you get.
Right.
You can have 10 audits on the exact same. So my advice, perfect example of an area you should be aggressive. Dude, I don't give a shit what your CPA says. You tell him it was $36,000 in repairs. Do you tell him? So if he says, prove it to me, say, you're fired. That's not your job to prove it to him. You're not committing tax fraud. That's a subjective decision. Send me an email and say, Aaron, what was Donald's name? Okay, I want your guy. Seriously. Some people are like, no, my CPA said I couldn't do that. No. They said they didn't want to. There's difference. Because think about it. If you get audited, your CPA doesn't like that. By nature, they're little nervous dudes. Okay? They're nervous Nellies. They're not rich men. They don't take risks. That's why they're CPAs. So by definition, they don't want you to be audited emotionally, mentally. If you haven't been audited, that's your problem.
So if you rip an old wall out and redo the plumbing and electrical in the interior of that wall, and re-sheet rock that, you call that repair.
Yeah, repair. Yep.
I like it. Love it.
I call it a repair.
Yeah, I love it.
And when I've been audited on that, it was not fully disallowed. So I happily paid penalties and interest on that. They disallowed about 15% of what I had taken, but about 80% of it was subjectively fought over. So I won. But I like that you counter that. Why is getting an audit bad? Let's have that debate.
That's more emotional.
It is an emotional, right? But look at this. I mean, again, regardless of what your politics is, Trump's been amazing. He's completely gutted the IRS over the last 4 years. They're at audit levels back 30 years, staffing levels back 30 years. Like the IRS is reeling right now. And there's never been a better time to elect to be more aggressive. Just look at it by the numbers. In 2011, 500K and up were being audited at a rate of 8%. It's even lower now in 2020.
I heard too, I don't know, is this true, that individuals get audited significantly more than
Yes,
even corporations?
absolutely. You know why? Because it's low-hanging fruit. Because the IRS, if you work at the IRS, you're not trying to police the country. You're just trying to keep job security. You're only making 70 to 150K a year. You don't give a shit. You just have to be able to show wins. You got to think about people's motivation. Let me give you an example. If you're doing a flip, you never want to completely rehab a home. You want to leave some obvious things not finished on that house to leave some meat on the bone for the home inspector. Because otherwise, that home inspector is going to be up in the attic checking the measurement in between, wiring posts. Like, you know what I mean? They will find something for the home inspection. So, yeah, leave the P-trap leaking under the sink. Take a picture, right? Leave them some meat on the bone. Let them fight and advocate for that homeowner. Aw, shucks. Okay, I'll repair everything. Thank God you didn't see there was no new insulation in the walls. Right? So, when you look at the rates, now, look at this. This is from February. IRS funding overall has been cut by 21%. IRS enforcement funding has been cut by 24%. The number of operations staff has fallen by 31%. And the number of revenue agents with expertise to conduct audits of complex returns has fallen by 35%. They're all going into private practice. It's never been easier to find an expert person to represent you in an audit. The audit rate overall has fallen by 45%. This is as of 2020. The audit rate for corporations with more than $1 billion in assets is down 51%. The audit rate for filers with more than $1 million is down 61%.
So presumptively in a Biden administration, they'll go, oh, we've lost all this money. Oh, so is there going to be a knee-jerk swing the other way, say, in that kind of administration that just makes this really nefarious?
So it brings up a great point. You get a group of people that will... Now, if you look back historically, let's say, like when they rolled out opportunity zones, all the CPAs and attorneys were saying, oh, there hasn't been a ruling on it. We don't know how this is going to be treated. But I immediately did some opportunity zones. Because if you look back legislatively over the past 50 years, if they pass a law because they pass a law and then it has to get challenged in court. But if you took advantage of the law because it was on the books, then you always get a pass if it works negatively against you. They let you backpedal, work backwards, so it's not punitive. That always is the case. Because, well, if you already did an opportunity zone prior to ruling number 23.46, then you can always return to the previous status and move, right? And so my rule is whenever there's a new rule, I immediately take advantage of it. If there's a new deduction, like the qualified business income deduction, I immediately took advantage of it because that's 20%. I'm a real estate professional. When I see this, let's say that Biden does that. Like, look, he's going to be getting his feet under him in the first quarter. What's going to happen? They're fighting all next year. So I'm not worried about 2020 filing. I'm not have to worry about 2021 filing. Let's say they do start hiring and get up to speed. I'm still not worried about it. Because again, remember, I'm not committing tax fraud. I'm not committing tax evasion. I'm subjectively taking anything where it's either or and taking the either to 100%. Let me give you an example. I don't do it this way, but people always seem to get really spun up about it. Home office deduction. Okay, everybody familiar with that, right? Now, what's the rule for what's the general rule for that one? For that, huh? Yeah, you have a dedicated space, whatever percentage that is of your house. You can deduct that percentage of your mortgage, your bills, your taxes, right? So, what if hypothetically I were to take 100%? Now, I don't have a mortgage, right? So I'm like, I should get more write-offs because I work at home, Meg works at home, my nanny, that's her place of employment, my mother-in-law, that's her place of employment, my 2 housekeepers, they work there, all of my kids are paid as employees. I can make the case, even my dogs, because they're marketing their models, right? So I got 14 employees working. It just happens that a home is a secondary function. It's office first, right? So what if I said, I'm going to take 100% of my tax bill and deduct it, and 100% of my Wi-Fi for the year, and 100% of my utilities? Am I committing tax fraud? No. Because if I get audited 10 times on the home office by 10 different agents, I guarantee you there will be 10 different numbers. Now, if I say, well, my tax bill is $2,000, I'm just going to make that be $5,000. My Wi-Fi is $1,000, I'm going to make that be $1,500. Am I committing tax fraud? Yes. Can you go to jail for that? Yes. Okay. So, but at the full tax bill, not a penny more. At the full Wi-Fi bill, not a penny more. Then I'm now. Am I going to lose? Yes, I will lose. But that doesn't mean that I'm committing fraud. That doesn't mean it's unethical. Huh? It's just subjective. I'm aggressive. I'm subjectively being aggressive. I'm being 100% as aggressive as I can. Because the real question is, what's the likelihood that I get audited? So I got like a 98% chance that never even gets looked at. And if it gets looked at, then I guarantee you they're not going to say I was 100% wrong. It's somewhere between. It's subjective. When we're talking about risk, I choose to take the maximum subjective risk when it comes to tax deductions. That's how an area of risk that I'm comfortable with. Because to me, the worst case scenario is not that bad. What is the worst case scenario? If you pay what? Penalties and interest. How much are penalties and interest? No. It's a max of 25% per year total penalties and interest. Okay, that's the max that you would pay. Now, here's what's interesting for me. When I invest money active, I usually average 40 to 60% cash on cash per year. So I got about $15 million I'm making 40 to 60% on. You with me? If I lose an audit and no penalties and interest, I'm still not screwed. Because if I took that deduction, I've had that money for, let's say, 2 years. I made 40% on it in year one, and then with that money plus the 40%, I made another minimum of about 40%. If they hit me for 25% for each year, that's called arbitrage. So what? I'm still ahead 15%. You call it penalties and interest, I call it a hard money loan from the IRS for 2 years. Do you see why I care even less? Because look, on $6 million last year, if I just went with the full, what do I owe the IRS? It's $2.4 million. I was able to get that down from 6 to 1 with write-offs, with deductions, and then pay 40%. That $1.4 million is real money that I can make real profits on by keeping it really invested. Here's the rule itself. The IRS will not. The late filing penalty is 5% of the tax owed. So if you extend and then you owe, you pay a penalty on that per month up to a maximum of 25%. There's also an underpayment penalty of 0.5% to 1% per month, also capped at 25%. Okay, so it grows rapidly, but it grows rapidly. 25% for a lot of people is a lot, but when you know what you make a year on your money, then it becomes not as big of a deal to me. Do you see again why I'm running it through 3 screens of aggressiveness that's custom to me as an investor? First screen, is it subjective or is it illegal? If it's subjective, then I'm cool with it. If it's illegal, I'm not interested. Okay? People say to me, hey man, I got a vending business. You know what I'm saying? Cash. I'm like, you're admitting tax fraud. What are you, an idiot? I had a pool constructor. He's like, hey man, I'll give people a 30% cash discount on their pools. Tax fraud, go to jail, not interested. Like, are you crazy? It's a felony, yuck, right? If my tenants come in with cash, I give them a 20% deduction. You know what I'm saying? Like, I don't understand that. When it's so easy to be aggressive subjectively, why would you ever commit tax? But there's always knuckleheads. You don't file a tax return. Do you go to jail? Yes. They'll put you in jail if you don't file. I had that one client in here, he told the whole class, he's not my client, he attended. I'm like, Meg, don't sell him. Told the whole class how the IRS doesn't have the right to tax. The United States government doesn't have the right to tax, and therefore he hadn't filed a return in 10 years. I'm like, okay, you live in Idaho? You got a bunker? My neighbor down the street from us has 1 million rounds of ammo. 1 million rounds of ammo at his house. He's got more than the sheriff's department. Yeah, and he's got a fully automatic shooting range at the house. You'll hear out there. It's nuts, man. I am not worried in Idaho I wasn't worried about any protests last year. No one's coming to protest in Idaho, I'll tell you that. It was crazy, man. Then the second tier is the likelihood that I think that I'm going to get audited. I'm comfortable with a 2% risk. Now, I got over 90 LLCs. So every year, at least one of my LLCs gets audited on something. A lot of times it's just a letter. Last year I just got a letter that says, hey, from this LLC that owns 4 houses, send us your Schedule C. Okay? But again, when you don't commit tax fraud, when you use a bookkeeper, when you reconcile your accounts, when you have financial controls, when you use an accountant that works for IRS, when you know that you've only taken deductions that are subjective, and when you know you're making 40% a year on your money, I'm comfortable with that risk. The willingness to take the risk comes from a place of personal application and personal knowledge. Now, I don't know how to file a return. I don't have to know that. Just like I don't know how to operate a paint sprayer. I don't have to know that. I just have to know the amount of skill required, the amount of time, the materials, and labor. And so learning to know what you need to know to quarterback your team is sports is a great application of that, because if you're the quarterback, you don't have to know what kind of gloves the wide receiver wears. You don't have to know his warm-up routine so he doesn't pull a hamstring. You don't have to know the kind of face guard the running back prefers. You just have to know enough about football to run the offense and win games. And some of you, your skill background becomes your Achilles heel, because if you were a CPA, you probably underclaiming. Like, if you underpay your tax, if you overpay tax, if you underwrite off deductions, nobody gives you a trophy for that. No Medal of Honor coming your way for overpaying. And if it was a function of your CPA in your ear saying, well, yeah, that might trigger an audit, that's five-figure mindset. I'm telling you, that's five-figure mindset. Unless you're committing tax fraud, then yeah, of course you don't want to get audited. I had a client say to me, hey, my dad's a tax attorney. It sounds unethical. I'm like, okay, let me just flip it back on you. Do you speed? She's like, yeah. I'm like, can you go to jail for speeding? Yes. You get a misdemeanor? Yes. Can you kill someone? Yes. So you knowingly commit a potentially felonious and manslaughter activity regularly. And you're telling me about ethics? Get the fuck out of here. Right? Like, you're lecturing me? Like, let's not flip it around. But again, at the end of the day, I said, no, I'm just kidding. Not really, just kidding. I'm not trying to offend. But that's why I said it's a very personal thing that everyone has to figure out. That's why risk is a personal thing. Because if at the end of the day, you don't sleep well by taking your whole tax bill as the home office deduction, then you shouldn't take it. But just know that potentially you're overpaying. Just know that potentially you're overpaying. Yeah?
It sounds like you may burn through the CPAs occasionally.
Nah, I've been with Donald forever, but I give him anxiety.
That's what I mean. But I was going to ask, your brothers, who those more riskier to see?
Not in tax. I'm more risky in tax.
Oh, really?
Yeah.
Okay.
He's more risky with debt and with his business. I like risk here and here. I don't like taking risk with debt or with my business.
Kind of where there are no limits.
Yeah, I'm more comfortable with that risk. So I'm like a 10 here and probably an 8 here. I'm probably a 2 here and probably a 6 here. Okay? Not qualifying it, not saying what it should or shouldn't be, but I'm just saying that you haven't thought about it too much. You haven't thought about it enough. And if you don't have a rational, do you see how I have a very, very multi-level strategy and reason when we talked through debt yesterday? You see how, for me, that debt structure works. It fits. It fits with who I am. It fits with my history with money. It fits with my narrative of how I've built my company. It's specific to me, just like my tax strategy. That's what you need to have. That's what seven-figure income earners do. As long as you have a very deliberate strategy for risk that's custom to you, then you're thinking like a 7, 8, 9-figure mindset investor. Yeah.
Are you able to talk at all, not taking you too off the course, on the opportunity zones? And I've wondered about those. Is that mostly from the development perspective?
Yeah, it really only works for new construction. Yeah, if you buy a property, the rule that what I've seen now recently is you have to spend 50% of the assessed value in improvements. So if you buy a property assessed for $60K, you got to spend at least $30K in rehab to qualify.
Does the Fed designate those areas?
Yes. In fact, if you just Google opportunity zones, it'll show you a map like this, and then you can put a property address in and zoom in to the street and see if a property falls in an O zone. And the other good thing is, unlike a 1031 exchange where you have to have a facilitator, the opportunity zone is an add-on to your tax return at the end of the year. So you say to your CPA, hey, I bought that house in an opportunity zone. Here's the information about it. And then your CPA files that like a paperclip addition to your tax return. That's one of the other nice things about it. Where I've seen it the most valuable is people who have a lot of stock or stock options who can fund it with money from selling stock, defer that capital gain. Is it 7 years, Kendall? Defer that capital gain, and then get a reduction on the capital gain. And then if they hold that property, see, I've seen people do that, and then they'll do flips, so like new construction flips in O-zones, and just keep reinvesting in O-zones, so they use it like a 1031 exchange. Yeah.
You said it mostly works in new construction, but you're getting the homes and doing that 50% ratio.
Mm-hmm. Yeah, it works for me as an active investor, but it's a pretty narrow slide. It doesn't work as well for like a passive investor, but it's a great active strategy. Oh, to this one? Yeah. Now remember, send me an email today, because I'll save the whole presentation with all of my chicken scratches in a Dropbox. Say, Aaron, PowerPoint slides, or send it right now while you're thinking of it. And then on the plane today, I'll just send you the Dropbox link. You can have all the slides with all the notes for the weekend. Okay? And you can say, PowerPoint slides, Donald, cost seg guy. You can say that. And then I'll copy Donald and Jed on the email. And then you'll have it all in one spot. Now the other Trump tax law that came out was qualified business income deduction. Again, only for real estate professionals. Kendall, what's the litmus for being is it 750 hours?
I think it's 70.
Huh?
70?
No.
700.
No, it's 7. Is it 7? I think it's 750.
Well, 750.
Yeah. Somebody asked the Google. I think it's what it is. It's a pretty high bar. I've heard from an audit standpoint, people who've been audited on it, because if you don't have enough write-offs, I can think of no greater argument than to be a real estate professional, because there are just so many ridiculous benefits, right? But then qualified business income deduction also has been big for non-attorneys, non-CPAs, non-engineers, non-optometrists, because what you're allowed to do is take certain income that you qualify for, and in addition to all the other write-offs, you can then take another 20% off your income. So those of you that are business owners, QBI was a brand new write-off that came out with the Trump tax laws, and you get another 20% after depreciation. It's a bottom line deduction. So, for example, my optometrist, he had the glasses in one area of the store, and he had his optometry practice in the other. He separated out the glasses as a separate business, because on the optometry business, the money he makes from doing your eye exam doesn't qualify for the 20%, but on the glasses sales, he can take the 20% QBI. I've seen law firms that have separated their building that the law firm's in from the law firm, because the law firm doesn't qualify for the 20% QBI, but the building itself does as a real estate investment. And so many real estate investments qualify for this deduction as well. Like, between cost segregation, pre-rehabs, qualified business income deduction, opportunity zones, if you are an active real estate investor or doing any kind of investing, if you're paying more than 10% on your real estate related money, you're doing it wrong. Trump hasn't paid anything in 20 years. Right? $750. And they're reviewing that. What did he get? A $6 million refund? $60 million. It's like $60 million refund he got. That was a nice refile. Now, one of the things that Donald can do for you, he can review your 2019 tax return still, and your 2018, and go back and refile. if he finds that you get more write-offs, he can get your refund. What better way to decide if you should switch tax guys? Let him review your. I mean, he and Caleb are both former auditors for the IRS. I'm comfortable with being aggressive under that umbrella. Very comfortable. And I'm even more comfortable when I do have audits, having them handle it. They're fantastic. I usually sign power of attorney so they can talk to IRS. I don't even want to mess with it. Low value activity for my time. Not worth $1,800 an hour. Questions about that? Like, I'm not promoting any more than I'm promoting that you don't have debt on your business. I'm not promoting that you be more aggressive on your taxes. I'm being a little aggressive from a teaching standpoint so that you listen. I'm trying to challenge you. I want you to think about it. Maybe be a little bit, I want your panties in a bunch a little bit, okay, to make the point. But make no mistake, I don't care what you do with your taxes or your debt or your business or your insurance from a risk standpoint. I'm transparent about mine so that you can think about it in a very concrete way, because we all learn by concrete examples. Does that make sense? Now, I want to show you, I work with about 8 different banks in the U.S.
Were you going to do screen number 3?
Which one?
Subjectivity, likelihood of an audit, and your third screen for, we kind of went on a tangent.
Oh, subjectivity, likelihood of an audit. Oh, and the return I can make on my money. The return that I can make on my money. Because I know that I can exceed the 25%. So even if I get hit with penalties and interest, as long as I've kept my money working, and as long as I've been hitting that return, I'm still money ahead when I lose. Because you always lose when you get audited. You never win. There's no such thing. I haven't experienced that. They're always going to disallow something.
That's subjective too. You lose something, but you don't lose, like you said.
You lose big picture.
In your paradigm of operation.
Yeah. Again, what? Yeah. Now can you see? I'm still very conservative, because if I wasn't making 40% a year, then I would be less aggressive with my taxes. But that's kind of like as long as I felt like I made 40% of my money last year, which I haven't missed that target in over 10 years, then I don't care. I don't care. Yeah, I always ping away from stuff, man. So I appreciate you reminding me. All right, so let me go here. That's not the one I want. There we go. Hold on, let me look this up real quick. Oh, damn it. That should be right. It's not logging in. I might have to figure this out on the break. Usually I have it bookmarked. Yeah, I'll figure this out on the break. Anyway, so I want to break down kind of how I've structured my personal asset protection and tax deduction structure, so that as you are mapping yours out, you can kind of see mine as context. Because I find like sometimes Kendall's going to come up today. He's going to go through for a couple hours some things that aren't generally covered by Clint, by Toby in the tax and asset protection, so that you guys can think about, because how many of you have an existing structure that Anderson's helped you put together? Okay, and who doesn't have any kind of structure that they put together with Anderson, right? So Kendall's going to kind of touch on both, but let me break down mine for you. So up here I have a Wyoming LLC, and a Wyoming LLC doesn't give you any tax benefits. The thing you got to remember is this for tax or asset protection or estate? It's kind of like one of those three from my standpoint. There's no tax, there's estate benefits, but it's anonymity. So the member in that LLC is my trust. Okay? So then, I got almost 100 LLCs in different states. Now, my rule of thumb is $250K of exposure. Based on my net worth, based on the amount of money I make, I'm comfortable with up to $250,000 exposure in any one LLC. That's a subjective, random number that I've chosen for what my comfort level is. What that means is if I have one property that's worth $250,000 or more, I put it in its own LLC. But if I have $225,000 houses, I'm comfortable putting those two houses in the LLC. If I have four $60,000 houses, I'm comfortable putting all four of those in that LLC. So one thing that each of you need to think about is what's your exposure comfort level with LLCs. In my case, it's $250,000. And that's just a number that I've chosen. Now, if I have a new business, then I put that business in its own LLC. I never like more than one business in an LLC. So Alpine Capital Solutions never owns properties. Alpine Capital Solutions doesn't do management. It doesn't do loan servicing. It doesn't do construction or leasing. The only thing Alpine Capital Solutions does is marketing. It pays for the event. It pays for the food. Pays for your hotel room. It pays for Facebook ads. It pays for my plane ticket to go meet with clients. And I run anything that's under that umbrella of marketing through Alpine Capital Solutions. Does that make sense? Now that makes insurance very easy when I do one LLC per business, because insurance brokers like Ashley love to see only one or a very narrow set of activities running out of that business. I don't think that you're saving money by putting more than one business in an LLC. Can anybody think of an example where it would make sense? Catherine, you think of anything? I can't think of where it would make sense to put more than one business in an LLC.
Not off the top of my head.
Kendall? More than one business. Like two businesses or more.
Usually for asset protection, if they're related, you can. So if they're both real estate related, but if you put, like, for example, a stock investing business and real estate or online and real estate together, you don't want that liability cost to go.
Yeah.
So, no, you really don't.
I really can't think of a reason. Now, Kendall, what are some ways to get, because when you have a multi-member LLC, when my ex-wife and I were brawling, she was able to freeze my personal accounts while we were going through court. But she couldn't touch my business accounts because they were multi-member LLCs. Judge wouldn't mess with it because I had other partners and business that was related to. Does that make sense? So, Kendall, if you own your own business, what's another way to get another member potentially on that LLC?
If you're single, for example?
Yeah.
Yeah, no partners. So a corporation can be your partner.
Yes.
It's a cool strategy. So you set up a corporation, that's your partner in your LLC, and boom, multi-member are much stronger than single members.
Yeah, multi-members in every, the rule of thumb is if you have a multi-member LLC, in any state, you're going to be fine. It's going to be very difficult for somebody to freeze that account. But there are some states where single-member LLCs, that you can get your ass kicked. Right, Kendall?
Oh yeah. Yeah, we'll go through some of that for sure.
Well, Kendall's going to talk about that in depth today.
They're nice because they're disregarded, so people love them, but as far as asset protection, most states, they're not very strong.
Yeah, from a tax standpoint, you're like, yeah, this is great. I don't have to file a return on the LLC. It's disregarded. But if you think there's litigation exposure, forget it. Okay? Now, yeah.
So let's say the 250 LLC on a property, you're doing some marketing for that property. Are you saying that your marketing deductions or some random deductions for that property, you'll run those through business LLC if it's market related or whatnot?
Yeah, I do that. And then the other thing that I do is all of my LLCs, I never keep profits in the LLCs. I run them all through. In my case, you're going to want either an S corp or a C corp, right? In my case, I use an LLC designated as an S corp for tax purposes. Now this is it, and that's my management company. Now, Clint, Toby, and Michael are big C corp guys. Big C corp guys. They're like, C corp's the best. As an investor, I don't agree. It's not the best for me. I like an LLC designated as an S corp. That's a better structure for me for a couple of reasons. Number one, I'm never paying 20% tax. For a lot of people who like C corps, they've been paying a higher tax rate. Gives them that lower tax rate. I'm never. I just went through the tax. I'm paying 10% typically. Okay, after adjusting my gross income down. I don't care about shares in my company, so I don't have partners where shares make it easy to divide up ownership. Shares make it easy to sell a company down the road. I'm not planning on selling my company. Shares are a big benefit. The double taxation is an issue to me. A lot of times they'll say about the C corp, well, don't leave any money in it. Well, I do leave money in my S corp, and so I like that there's no double taxation from that standpoint. And so for me personally, I'm not utilizing a C corp. Although I have thought about setting up a C corp lately just for the purpose that Kendall just mentioned, so that I can use this C corp as an additional member on my LLCs. Now, Meg has a management company that she uses because if she sells a property this weekend, Alpine will pay her a marketing fee, a flat rate fee for each deal. And so she's set up as a 1099 with respect to Alpine. And so a lot of times I've used her LLC as the second member, but a C corp is a little bit cleaner. But again, you see how custom it is. And so, it's something that you need to figure out. In my case, it's an S corp. Now, to make the S corp a legitimate management company, I do payroll. And the rule of thumb, if you get audited, is the salary appropriate for the amount of business that's being done? Over the years, that payroll amount's gone up for me. Right now, it's about $8,000 a month. Meg has an S corp also. It pays her, I believe, right around $7,000 or $8,000 a month. Now, I don't put the pay, because then over here I get my personal account. And that's at Bank of Idaho. I don't put the payroll in my personal account. I actually send the all $8,000 straight to IRS. So that every year I've already prepaid $96,000 in federal tax. Okay, I've already got a head start. Usually still owe 300, but and then 50 or 60 for state. But I'd say for the last 7 or 8 years, I've been able to get it down to about $1 million of adjusted gross income, and then I'm paying $300 to $400K. Okay. So got to have payroll and got to file quarterlies. Donald's guys do that for me. They file the quarterlies for me to keep it legit, okay? Because then, as I'm doing my spending, what I wanted, it's not that rich people have more write-offs, it's just that they spend more out of their business. So out of my S-Corp, pays for my cell phones. I never take vacations, I take business trips, right? Okay? A lot of my clothes come out of the S-Corp because I could show videos where I dress like this all the time. This is business attire for me. You know? That's why I make sure I wear a pair of shorts, a pair of joggers, a pair of slacks, because then pretty much everything. I never buy clothes out of my personal account. Ever. Not anymore. Flip-flops. I should have rocked a bathing suit last night, you know? Okay. My little Tommy just hit me up. He's been doing water polo. They have jammers and then they got Speedos. And Casey was too embarrassed to rock the Speedos until he was a sophomore, because now he's all shredded, six pack. Tommy's built like me, almost identically. And so he was like, nah, Dad, for water polo, I'm just going to do jammers. And then he hit me up yesterday. He's like, Dad, I need Speedos. I was like, yeah, you're going to look like Chris Farley out there. He's like, and then he told me to F off, which he's allowed, If I tease him about, looking like a little polar bear. So that's the big thing is I literally wear out my S-Corp debit card every 6 months. This year, I think I've only put, I have nothing in my personal account. I maybe have put $60K in there. Because where do I pay my kids? They're employees of my S-Corp. Out of the S-Corp. Now let me talk about that for a minute, because who doesn't currently pay their kids? Who does not currently pay their kids?
1099, but we were considering.
Oh, dude, it's the way to go. Now, the litmus test, again, Kendall, what are some of the constraints around paying your kids?
Oh, yeah. So there's age issues. So generally, 18, older, generally around 18, and then, it's really necessary or reasonable, right? What's necessary or reasonable? That's pretty wrong.
Have I not had my kids up here at a for-profit event? Did we not talk about them? Okay, they're models. Models. They're part of my marketing. Didn't we talk about them like numerous times over the weekend? In the summer, they're here. I make sure they come. They're as representatives of the company. Now, people always laugh at that. You think I'm bullshitting? You sit down with IRS and show them how you're using your kids in the marketing, how they attend the events, how they attend the cocktail parties, and help to facilitate sale of property. Like, if a newborn baby that's 2 days old can be in a diaper ad or a milk ad, all you need to have is a Social Security card to make money in this country, Social Security number, and you can earn money. A 1-day-old newborn can earn money. So, but let me tell you why that's so powerful, because if I pay, like now, for example, now Kendall, what's the most amount you can pay your kids without having to file a return? Is it only $2,000? Check with Don. I think it's more than that. Is it changing next year? So think about it this way. You could pay your kids $10,000. You don't even have, you have to 1099 them, but you don't have to file a return for them. And if you pay your kids 10 grand, can't you do their $6,000 contribution to their Roth? With the first 6 grand can go into their Roth? Now, if you don't even have to file a tax return, do you owe anything? No, you don't owe anything. If they're like, don't even bother. You owe no tax. If you only make 10 grand in this country. You don't have to file. So, but if you put 6,000 into their Roth, does the IRS not see that as a tax, after-tax contribution? But isn't it for all intents and purposes a tax-free contribution? And then once it's in their Roth, will they ever have to pay taxes on the growth? No. And then for the rest of their lives on the distributions, will they ever have to pay taxes? No. So now you've created a triple tax-free scenario for your children. 6 grand a year and no limit on the growth. Imagine saying to your kids, you're 18, the 5 houses are in your IRA. Because that's what my kids are getting. Then I started thinking, wait a minute, when they're 18, it's their IRA. So they could take money out. And I'm like, I just had this vision of Tommy selling a house and going to Singapore to find himself, you know, smoking heroin, like, because he can, it's his IRA. And then I learned about friendly liens. So Tommy's got a house in his IRA right now that's worth about $80,000, and one of my LLCs has a lien recorded against the title for $500,000. So when Tommy turns 18, he could go sell that house, maybe for 100 grand, and the title company's going to say, that money goes to this LLC, is the lien holder. And Tommy's like, wait, what? There's no lien on that property. Yes, there is. There's a lien on there. It has to get satisfied. They got to sign a release. And Tommy says, what's the name? It's called F.U. Tommy LLC. Because it's my money. Maybe your IRA, my money. So I just make sure when they turn 18, there's no cash in their IRAs. Only assets. Strip all the cash out. I'll buy I'll make a loan out to one of my LLCs. A 100-year loan, right? It's there, but it's not theirs. See the difference? Again, you know what another triple tax-free self-directed opportunity is? Home health savings account, HSAs. Hey, who has an HSA? IRA Club does self-directed HSA. So what I did was, what they'll do is they have a third-party provider. They set it up when they say, well, how much money do you want in the account that's tied to the Visa debit card for the HSA? In my case, I was like, none. Yeah. And then I left the rest in the trust account at IRA Club, and then I've been putting it into flips, back and forth.
Can you roll over?
Yeah. Yeah. I actually rolled mine over because when I was shareholder at Bank of Idaho, I had an HSA there, kept it with the bank, but Dennis, IRA Club came out with that about a year and a half ago, and I just transferred it over.
I have two employers stable that do that kind of stuff.
Yeah.
One did what you're saying, that could invest, leave them alone, and leave off the one. But I got money scattered everywhere.
I know, yeah. Imagine if I could get, my goal is to get like $1 million built up in my health savings account for when I get old. That's when you have the really expensive, if you get cancer, you get, you have some really health issues, and now I'll have all that money. I don't need it now. I get no problem paying out of pocket with my S Corp right now. Okay. We have a high deductible plan. Meg's kids are on their dad's police insurance, but my boys and Meg and I are on a plan. In Idaho, it's $1,500 a month and a $12,000 deductible. But I mean, we don't have insurance in this country. It really sucks. The rich people, they don't care because what's 12 grand to me? I don't care. But think about Buster and Carmen. Buster and Carmen, I forgot to congratulate them. They are now 18 months smoke free. They were both, Buster was smoking 3 to 4 packs a day since he was 16. Carmen was smoking 3 packs a day. They quit a year and a half ago. So proud of them. But they got 3 kids. They tried to go get insurance on the Obama exchange, on the health exchange, and it was like a similar plan, $1,500 a month and $10,000 deductible. So they just didn't even have insurance. They would just go to the emergency room because they made too much money to qualify for Medicaid. And so, they were a huge motivation by why I voted for Hillary the last time, thinking about them, how this country's insurance isn't working for 2 hardworking, good parents in this country. That's partly why I voted for Hillary, hoping that she would win and fix healthcare. Trump didn't fix healthcare, and so I bought insurance for every employee. And Buster and Carmen now pay $300 a month premium, and their deductible is $500 because I pay the difference basically, and we have a group plan, so you get a deduction for that. And it's expensive, right? It comes right out of my pocket. But I feel like as a business owner, you don't have the luxury of being super partisan. When politically, you just have to make it work for your tribe. You got to take care of your family. You got to take care of your employees, take care of your clients, take care of your customers, and hope that the rest of the country can get their shit together, because there's a lot of people that it's not working for in this country. It's really, I only see it getting worse if Biden wins or if Trump wins. It's very, very, how many of you didn't really like either candidate? That's like the majority right now. People are just like, ugh, I hated both options. I didn't want to waste my vote, so I chose, the lesser of 2 evil. Yeah. That's why I voted for Kanye. So who has a, what are the savings accounts for college called? 529. Who's got a 529? I would much rather use a Roth for my kids, because a Roth, well, any IRA, they can take $10,000 out for medical, qualified distribution from the Roth. They can take tuition, books, housing, and fees out of a Roth, or well, I don't know why you wouldn't do a Roth, so I say a Roth. They can take everything a 529 plan out. They can take out of their Roth. But if your kid doesn't go to college, then you're screwed on the 529 plan. But if they don't go to college and they have a Roth, they still have it for retirement.
Is there any way to convert that?
No, I don't think there's a way to convert a 529. I know. Somebody asked that last month.
Because one kid uses it, if I go out to college, I can use that 529.
Yeah, I'm just saying if you have a 529, unwind it maybe and start paying your kid with that money, and then get it in the Roth. Because a Roth, I think, does everything a 529 plus way more. I think a Roth, every one of you should have a Roth. Each one of your kids should have a Roth. And you should be paying your kids at least $6,000 a year. If you have the money, set up a Roth for your grandkids. Pay your grandkids. Put the money in there. Yep.
How would I justify paying my kids when they're only home a few months a year, because now they're older and they go away to college?
Oh, they're out of the house?
Yeah.
Consulting. I mean, justifying paying somebody $10,000 is pretty easy. Because you could do something like make them an administrator on your Facebook business page. It takes 5 minutes to set up a Facebook business page. Make them the administrator. Tell them to post and do updates. What a great way for an audit to say that they make $1,000 a month for updating my Facebook business page. Find an article and post about it. And then boost the ad for $20 a month, right? Pay it $20 to Facebook, put a credit card on the business page, pay $20, boost the ad, because now they're paying for advertising, they're responding to the posts, they're managing your social media campaign. Have them do the same thing with Instagram. That's an easy way, and your kids are probably much more tech savvy than you are. Yep.
We didn't do the 529 time, we did the Roth.
Yeah.
The nice thing is that, like, some of our kids have gone to college. One of my daughters did her master's, but yet my son, who's in real estate, he's 24. He's taking the money. He's going to be buying investment properties with his money. So it really is a great
It's
flexibility.
It sucks because how many of you are hearing some of this for the first time? Like, why is this not K through 12 more? That's why I try to scream it every month. But, that's the educational gap. Yep, Justin.
You have multiple kids. You have one kid do Instagram, one kid do Facebook, one kid do Twitter. They each are separate.
You can have 10 administrators on one Facebook page too. Yeah, it's easy. Just have them do some ads because then it's legit. You're spending money on advertising. You're promoting that business. Such an easy way to loop them in. Okay. Any other questions about the way that I structure it? Yeah.
You have tenants or somebody holding the notes. You have them paid to the LLC or have them directly paid to the SC Corp?
If they're living in this house, I'll have them pay Alpine, the management company.
What was the question?
Do the tenants ever pay the C Corp or do they pay the S Corp or do they pay the LLC? I actually have them, if the property's held in this LLC, then they pay their rent to the management company, which is one of the other LLCs. And then the only way that would make it, so for example, I take 40% of the profits per month that Alpine Property Management Indy makes, right? That goes to my S Corp, the profits. Yeah.
So that S Corp is really managing the management company, but the management company that you're saying down there is managing the property.
Yeah, you could say it that way.
Okay, because otherwise it's
Well, yeah, actually, technically the management company is managing them all from the IRS standpoint.
okay.
But from my standpoint, they're all like, it's all nepotism, right? It's all over the place.
If you had them pay the LLC directly, what's wrong with that?
Nothing. Nothing. So one of the things that I do is I always set up a bank account and I do online QuickBooks for every business. But if I have a holding entity, I don't like to set up a bank account for the holding entity. That's why I was going to log in and show you that just here in India, I have like 70 bank accounts, right? And I have over, no, not 7, no. Just here in India, I have probably 45 bank accounts. Across all markets, I have 70, but I really don't want another bank account because then I got to pay my bookkeeper to reconcile that. And so I have quite a few holding LLCs that don't have a bank account with them, just an online QuickBooks. Because I'd rather pay that rent to Alpine and then have it distributed to my S Corp. Yep.
So how does all this relate to your trust?
So I have the Wyoming LLC be one of the members of every LLC that I set up. And by doing that, then I've put everything in those LLCs is now inside the trust. Because if the trust is the member of the LLC, the Wyoming LLC, and the Wyoming LLC is one of the members in these LLCs, then whatever is bought in that LLC by default is in the trust. Great question.
Your living trust, right?
My living trust. But soon to be my South Dakota trust. Actually, what I'm going to do is just set up a South Dakota trust and then take a couple of entities of some of my favorite LLCs. Like I got a commercial building downtown here, bought it for 30 grand, it's worth 700. Never selling that building. Because I think it'll double over the next couple of years. I'm going to put that in the South Dakota trust. I'm going to put my house down the street in the South Dakota trust. Separate the South Dakota?
Yeah.
Because I keep hearing about them, so I want to test it. Anderson doesn't do them. And so I'm an investor. I see all these billions of dollars go into it. I want to see how good it is. And so I'll make our trust be the beneficiary.
Okay.
Now I have a secret LLC. Don't tell Meg. Right? Yeah, just so I can say it, because then I'll report back to Kendall, report back to Anderson. my experience with the South Dakota Trust. I've just $300 billion is enough for me to be interested in South Dakota Trust. I want to see what they cost. I want to see how it works. I want to see the packet they send me. Trav's going to do it too. We're going to take we have this amazing new office in Charlotte. We've had 2 offices in Charlotte for what, 4 years?
Actually,
When did we buy number 2?
we got the second one in 2015.
5 years ago.
Yes.
And the first one, Trav bought it like 15 years ago.
Yes.
But we got number 2 office 5 years ago. We've been in that one, but then we were thinking about building a mini version of this on the location of number 1 office. But we would have had to, we would probably be about 300,000 or 400,000 short. So I said, let's just gut this office to the studs and blow out and add an addition. And so they've done that. 4th of July weekend, it was interesting. 4th of July weekend, an extra 1,000 square feet magically appeared on the back of our building.
Absolutely.
Craziest thing. Just popped onto it like grew. It became a real boy and just grew out. We were so proud of all the vegetables it had been eating. Trav and the team got in there when all the building inspectors were celebrating 4th of July weekend. Just kidding, that didn't really happen.
What do you think some of the benefits the Dakota holding company will provide?
What I've heard is that once you get past 24 months, there is 0 civil litigation that can pierce and know what's held by that. It's impenetrable once you get past 2 years. Only criminal litigation. And like I said earlier, I have 1/100th of 1%. I don't do criminal shit, so I'm not worried about that. Civil, I have civil every month. There's always some counterclaim by a tenant, lawsuit with a contractor, lawsuit with another investor that I've been dealing with. So I love the idea of potentially putting my very best properties in Fort Knox.
Just another layer.
Yeah. What I've heard is it's even more impenetrable than a Wyoming LLC. Now, when I hit Toby and Clint, they're like, nah, it's the same difference. I'm like, okay, well, I'm still going to check it out. I get that Anderson may not want to set up an office in South Dakota, right? I understand from a business standpoint, but from an investor standpoint, I Columbo through everything. I'm always, testing shit out to see how it works. I never take anyone's word for it. Yep.
Now, is that 24 months per asset going into a trust?
I don't know.
Or just the trust as a whole?
Don't know. Yeah, good question. It's like you never really know until you say yes, until you do. You only learn by doing. That's why I've just learned that over 20 years. Now, my brother, he's smart enough. Like, he would ask all these questions and then make it. I don't do that. I'm like, I got to try it. I'm doing my third round of storage units right now. Just like with the modular home. With that modular home, we didn't know. We just did it, and now we figured it out, and we had like 10 mistakes that probably cost me an extra $15,000 that we're going to correct on the one next door. But it's funny. I post that modular home on Facebook, and people come out of the woodwork. Yeah, Aaron, I'd like to be able to pick your... Nope. Little red hen. Sorry. You don't get any of the bread. One guy here was like, would you let me? No, Sean. He was a wholesaler, but now he's an investor. And like, would have been nice you kept giving me deals over the years, but you got greedy. Why would I help you now? Well, I can start giving you deals again. Not interested. Little red hen. Sorry, dude. Go do your own modular. Pay your own tuition. I paid a lot of tuition figuring out modulars. There is no seminar on doing modular home development. I would have gone to it. The next one is moving and setting homes. We have a moving and setting company in Kansas City. There's no training. You can't go to like a truck driver training and go learn how. But we just made $80,000 last month moving and setting homes for other park owners. $80,000 in gross rev with 10,000 in overhead. So now I'm like, whoop, Trav, we're going to set up moving and setting in Charlotte. We're going to set up moving and setting in Idaho. Then we're going to set it up here in Indiana. Why not vertical? Add some moving and setting companies. Mover and setters don't want to get in the business. That's like a toothless hillbilly, business that nobody's like, oh man, I want to move and set mobile homes. That's my passion. I burn for that. Like, I just feel that business, right? I paid my Dallas partners. Their son just graduated from Texas Tech. I paid their son, him. I moved him to Kansas City, rented him an apartment for a year. I'm paying him $500 a week. I'm like, you're gonna learn moving and setting. By April, I got 100 homes I need to move and set. You're gonna do them because we're gonna do that in Idaho, like set up. Oh, we had a Ramez. Oh, for the HSAs. How much?
Family or single?
How much is to set up a family?
7,000.
No.
How much? I'm so sorry.
You get screwed on the HSA.
Let me just confirm what a single is 135. I'll come back and confirm.
It's like a couple $100. Yeah. So those of you that want to do HSAs, also hit Ramez up, and then you can self-direct. Because all you'll do is they'll say to you, how much do you want to put on the card at the bank account? Because they use a bank who offers the HSA. And then how much do you want to leave in the trust account at IRA Club? And then invest it. And then you self-direct it. It's great. Any other questions?
I don't understand. Are you saying then you pay your medical bills out of it? You don't pay your medical bills out of it?
I don't pay my medical bills out because in my mind, I don't need that money. And so I left $500 on the card, but I haven't even taken the sticker off it. Right? I'm not using that. I'm just going to, I left it in my desk. I'll use my S Corp and just, just pay. I just pay out of pocket. Now, a C Corp, that could be another reason why I might want a C Corp, because I could set up a benefit plan that the $1,500 a month in premium, because really, I'm completely losing that money. I can't write those off from an S Corp. But a C Corp, I could set up a medical plan that would allow me to write off that $1,500 a month and any other expenses. I could use the C Corp debit card for that. I probably should do it, but it's like, I've just been lazy about it, yeah.
That's good if you're not eligible for HSA for some other reason, then C Corp can do it still. It's taxable as the same.
Are you guys run your health out of the C Corp?
But I'm not eligible for an HSA because I'm
So you have a high deductible plan? And then
I'm not eligible for an HSA because of military.
But do you pay the premiums out of your C Corp then? Or if you take the kids to the dentist, how do you pay for it?
We pay us, or we reimburse from the C Corp.
Damn, now I need a C Corp. Shit. Because I probably spent between dental, because I just pay cash for dental.
Braces, that pays for it.
I already paid, braces are done. We're out of the braces. And that was just non-deductible out of my S Corp. But how much does it cost to maintain a C Corp per year? What are you spending?
It's an LLC.
Oh, yours an LLC?
Yeah, LLC taxes a C Corp.
Trav, do you have a C Corp? Oh, yeah, we do. Shit, never mind. Hey, that's what we should do. That's how we could wash.
Yes.
Oh, now it's on, dude.
30 years in healthcare, set up a plan for yourself, put your entities in it where you want, set up one for your wife, put her
Yeah.
entities in it, bump them up each other, we don't have a deductible, because it's the birthday rule, whoever is primary will pay, whoever is secondary will come in and take that. It costs you the same.
Really?
Yeah.
That's very ninja. See, we haven't really used. I haven't been in the doctor in years. I'm never get sick, so
If you have like a long-term hospital.
I know. I'm so bad about that. I've been neglecting that. I need to get. All right.
Yeah. So,
I haven't sent myself an email, but let's do that. Because we set up a C Corp for an interest we have in a trailer park in Charlotte. I forgot about that. And then Trav's bookkeeper sent us a tax bill, and I'm like, what is this? Like, yeah.
Did somebody say LLC taxed as a C Corp? Yep.
Yep. You got. I heard it has to file a tax return, so you got $500 for your tax return. But other than that, it's just
What's the benefit of that?
Medical reimbursement. An S Corp can't do that with a C Corp.
Yeah, see, I had just paid for it out of my S Corp, and I was like, yeah, whatever, it's not that much. Because, we haven't been sick. But We literally, I literally have not used insurance 10 years for me or the boys. And then all dental, I just pay cash. Yeah.
So if you have insurance, like from a 10 or W-2 job,
Mm-hmm.
and you still have to pay deductibles and pockets and all that, you can pay them through your LLC?
So that's actually what I do. I have, my employer pays my healthcare, and I've got co-pays and those kind of things. So I just pay the co-pays. So like, I've got a bunch of kids that are going through braces right now, and dental coverage is like a $1,500 lifetime cap, right? Braces cost like $10,000. So above that, it's all medical. So
So then you pay that out of your.
out of my,
business
I
corp.
reimburse it out of my C corp for any out-of-pocket expenses. So it becomes pre-tax dollars.
That is good. See, perfect example of, we all have these like, has anybody ever seen the book Good to Great? Good to Great. One of the analogies they use in the book is that good companies clean the dust out of the corners of their company. They confront those initiatives. And we all have financial dust bunnies sitting in corners or closets that are filthy, right? Depending on. But my healthcare, because we haven't been sick, I haven't been sick, my boys haven't been sick, for me, it's my sloppiest area of my finances. Because I'm like, I don't want to deal with the headache of that C Corp medical bullshit when all I'm doing, my boys went and got some fillings last week. I just S-corped, S-corped it out. So, cool. Yeah, this has been a good discussion. Any other questions? Yep.
I know you mentioned you have 70 accounts. Is there certain banks or community banks you would like to work with?
Yeah, so like here in Indiana, I bank with Huntington, but then like everything in Idaho. Then all of my businesses, so like in Idaho, see, it's driving me crazy. Like our dealership, I can't log into anything today. That's not a good sign. And then in Charlotte, Trav, who do we bank with? New Dominion, in Kansas City. So in each market that I own businesses, because I always set up a business account, but I don't want my business account for my Idaho dealership to be in Indiana. So I like the business account to be regional to the LLC and the business itself. And so I've gone with small bank, because like perfect example is Bank of Idaho. They target businesses that do between $5 and $50 million a year in revenue, and that's their preferred customer. Huntington Bank targets the businesses up to $100 million, and so it creates. I have personal access to the CEO of Bank of Idaho. I have personal access to the senior loan committee at Huntington Bank because of the volume that our business does. And so it's like when I mentioned yesterday that lending is a personal relationship. That's why I like those smaller banks, because when you have that personal relationship, you can ask them for non-recourse loans. You can ask them for those types of benefits.
So like we have I want to ask you how much you pay.
Yeah.
We have our operations, our real estate brokerage commissions, whatnot, going through, let's say, Bank of the West.
Yeah.
Bank. But I have a banking relationship with Albuquerque City Bank. Would you recommend the additional acquisitions that we make, that those LLC bank accounts in the local bank?
Yeah, I think as much as, because one of the problems with the local bank is like, their online sucks. I can't easily wire online. Where like with Chase, you can wire from their app. It's so amazing. And there's ATMs everywhere. But that benefit, which is good for non-business owners, is not a big of a benefit when you count the access that you would get from that little bank. Yeah, and it's just you can't quantify that value in terms of lines of credit and loans, because I can call Caleb at the Bank of Idaho and say, hey, this is what I'm looking at. And in his mind, there's no question whether I'm financially solvent, because he can look, Aaron's got $1 million in different businesses right now with us. And over the last 12 months, he's flowed $8 million through our accounts. So just from that, that's a nice starting point. And then I link them in with like my Huntington contact. Hey, could you call Bank of Idaho and let them know what my book of business looks like in Indiana as needed? Then they can, because then it's not like, well, you need to provide us with financials. Well, we don't need Aaron to provide us with financials. He's a client, and I talked to his Huntington guy. That personal aspect, you can't quantify it, because then Caleb goes to loan committee meeting once a month, and he sits down with a CEO and another VP, and he's like, so we got this request from Aaron. He wants a non-recourse 40% first mortgage. And they're like, oh, yeah, oh, Aaron? Okay, yeah, shareholder, yeah, all right. And
Yeah, that's one bank, we helped them just get $1 million loan. I'm on the board with an organization in town, and we needed a construction loan for the build out.
yeah.
So helped him, so that probably will also help.
Oh, hello. That's like one of my buddies I've known. He's a lawyer here in town, black guy. I helped him get elected to a city council position in a black neighborhood, a neighborhood that we do a lot of business. We buy a lot of property. He literally texted me to give me a heads up on some pending revitalization that was just on the board. I mean, huge, right? Or I can text him and say, hey, XYZ initiative, how's it looking? Do you think it's going to get approval? Yeah, it's looking pretty good. Our current mayor, I gave him $5,000 before he ran the last time. I got a text from his campaign manager. Hey, Joe would like to meet with you. Actually, it was really funny because a few years ago, there was this massive fraud that took place with the city. The city had a land bank with a bunch of properties in it. And the city had this provision where a charity with a housing initiative could go grab the properties from the land bank for $1,000. So if you were a charity that had a housing initiative. So we went to a charity called Homeless Reentry Helpers. And we said, hey, go grab some of those houses and then we'll rehab them and sell them to our investors. And we'll buy them from you for $10,000. And he's like, my charity is so broke. I have no money. I said, okay, I'll loan you $10,000 to go buy 5 houses. And he did, right? And I picked out the houses. It was great. And then we rehabbed the homes. He asked me if some of his homeless guys could do work. I was like, love to have them demo the houses out, and pay them for that. Any kind of handyman type labor they can, if they want to roll paint on the walls, great. So it was this really cool initiative. We legitimately helped the charity. They helped us get deals. We sold properties to our investors. These were properties that were war zone pieces of crap, just sitting on the books of the city, blights in neighborhoods, not paying property tax. We're bringing investors from around the world to buy those properties. So outside money is buying these properties here in the U.S. We get a bunch of street cred with the city. Well, the guy who ran the program for the city, for the land bank, set up a sham charity and started cherry picking. So I would go drive like 100 properties and I would choose the 20 best ones. And because he knew that we were doing our due diligence, he would then take to the 2 or 3 best that I had cherry, because then I'd come in and I'd submit 20 properties. He'd be like, oh yeah, those are already taken. Those are gone, right? And then he was selling them to his charity, and then his charity was just flipping them to investors around town. And at one point he said to me, hey Aaron, if you want to participate, I hate to see you losing properties every time. There's a way we could plug that hole in the sieve and you could get every deal you're requesting. I was like, hey, bro, that sounds shady AF, not interested. Want no part in whatever I'm fine getting 15. I wish I would have got the other 5. Those happen to be the best ones, but whatever. Deals are deals. I'm not playing that game. No, I'm not saying, okay. So, long story short, then I sit down with Joe Hogshead, the mayor. He's like, Aaron Adams, I've listened to your phone calls. I was like, what do you mean? He's like, well, when we were going after the land bank guys, we had phone taps, and so I've heard your phone calls. You're an honest man. I've heard you. I know you wanted no part of that shit.
Awesome.
He's like, what do you want, Aaron Adams? You gave me $5,000. You got cred with me. And I was like, just information, Mayor. I just want information. I want to be able to know, how things are going. I don't want a position in the new administration. I don't want to be I just want to be on your radar. He's like, well, here's my cell phone. Okay? So political activism and involvement, that's why I always register as an independent. That way, I can donate to both sides. Register as an independent. And being involved at the local organic level of city council, mayor, man, it just, plus it's just, having that reputation in town, every city in America has a big, small town real estate community. And you can't put a price on, like, you know, I have one person that deals with courts, and so we'll buy a home that'll have like a demolition order or you know, citations from the city. All my person has to go and say, hey, Alpine just bought it. They're like, the judges, oh, Alpine, okay, how much time do you guys need to fix it up? Because they know we don't hold shitty homes. They know that we do a nice job on our homes in every neighborhood of the city. So personal relationships always matter in business. And if you're a business owner and you're not parlaying that politically, you're not parlaying that financially, you're not parlaying that within the real estate community itself, you're missing out on money. Because, you know, an abundance mindset is if I'm a good citizen, if I always try to be honest and ethical, if I try to create win-win wherever I go, the money will always flow to me in abundance. That's what that translates to. That's the translation of how to build an amazing business. That's how you do it. Okay? Questions about anything we've talked about this morning?
Which bank do you use in Quincy?
I can't remember. It's this little hometown bank up in St. Joseph.
Sorry, it's superfluous.
Yeah, for me. Yeah.
No worries.
I can get that for you, though. Hit me with an email. Okay. Any other questions? Brittany, anything to add? You are? What'd you learn this morning, Brittany?
I come here every month and I hear the same thing over and over, but it doesn't really apply to you, it applies to you. I had a SEP IRA here with them for at least 3 years before I realized, and I've only been putting in $500.
No way! That's a great story.
I was like, hey, I need one for my husband. Just do whatever I already have. And I filled out the paperwork and I almost threw up.
And they're like, wait, you, what?
52,000.
56 now. Yeah.
Wrote a check to Rhonda, and I was like, can you deposit this for me? Just like that. The one that I always forget is the same thing with you and I are talking about medical insurance. Because like where I live, it's cheaper for me to pay tax.
C Corp.
But I make way too much money to not have it.
C Corp.
I'm not saying I don't, but I have 7 companies.
That's what we got to use.
And they're all S.
Yeah. See, my very next step this week, I got to get the C Corp Trav and I already have to do our health benefit plans. So now I got homework. Now, and I hold myself accountable by sending myself an email. So that's what I'm going to do on the break right now. Do C Corp in Charlotte for health insurance. Yeah.
The strategy you're using for get small holes, administrators, other jobs,
Yeah.
that can apply to other family members, right?
Mm-hmm.
Okay.
Yeah, you can pay anyone. Anyone can be your employee.
Okay. So that's all it is.
The thing you want to, the goal, the fundamental principle that rich people are doing is how do I put less in my personal account? Because the second you put it in your personal account, in my case, every dollar I spend out of there has a 40% haircut. So I never want to even put money in there. I want to spend it somewhere else. That's why 90% of my vacations are with Travis. Trav and Malou are easy to travel with, and we go all over the world together because we're partners. That's the easiest, that's our quarterly meeting for the C Corp. And so, and if you like to travel, hit me up because we'd love to, come join us on one of the trips. Right? We'll all go on a cruise together. Has anybody listened to Bill Maher? Is that his last name? No, Bill Barr. Bill Burr. Has anybody listened to Bill Burr? B-U-R-R? He's like my soulmate. That guy's so funny. Last night he was talking about how he would fix the overpopulation by sinking cruise ships. He's like, so I'll take over as a dictator in the country. I'll control the media, and then I'll sink a cruise ship, but I'll have another one being built. It was like, I don't have the people. And that's how we get from 7 billion to, and then you'll just notice like less traffic all of a sudden on your way home, right? Thanks to me, the dictator. We were like watching it last night, just crying. It's on Netflix. He has a comedy routine. Super dark though. So if you're a Darth Vader, Meg was actually even laughing. She had this like horrified look on her face. She was like, ha! During the whole routine. And Trav and I are like, ah, 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 ah. All right, so let's take a break. And then I want to get Kendall up here. And Kendall's going to, I promise, Kendall's presentation will not be like Michael's. You know what I'm saying? You're going to learn a lot. You're going to have a lot of questions afterwards. So, and we have I think we have my favorite donuts. It's Sunday, it's cheat day. So my favorite donuts are going to be here at some point today. They're crack, like really, they're heroin mixed with crack. So if you have a sweet tooth, you're going to want one when you see them, when we put them out there. I love donuts. Only on Sundays, because I'll get too fat. I won't be able to wear my Speedo. and you can see these are all different businesses that I own that are here in Indy. Okay, so these are all different. Everything like Alpine Property Management, Alpine Capital Solutions, operating, loan servicing is here. Okay, so there's $6.5 million undeployed in Indiana-related businesses that I have here. And then Idaho obviously is a smaller operation, but in Bank of Idaho, there's our Slate Mountain Homes. That's our dealership. 500-yard Properties is a small mobile home park that we own. Riviera is the trust account for the apartment complexes that we own. Okay. So, but look, my personal account, joint checking, only has $7,300. Only $7,300 in my personal account. Look how little money I put in there. I hate putting money in there. Hate putting money. I put $5,000 in November. In 15 days. That's it. So I had a check go to. I don't even know. Oh, housekeeper.
That's an investor mindset. Most people think they have to have that big chicken account.
Okay.
Yeah.
I put $5,000 in October. I'm telling you, I didn't put 60 grand in there this year. I don't think. 5,000 October 1st. Yeah, so maybe 5 to 10 grand a month.
Is your so we doing something similar, but our account, our previous account that we got rid of, used to tell us, you guys have to take more money. You're not taking enough money. You're gonna get audited. You're gonna lose your S corp status and all this. Is that bunk?
Yeah, it is.
That's bunk.
But
Your status, I don't know, lose it. I mean, it's your S corp.
What's that?
It's your S corp. Yeah,
She said we would lose our S corp status because we're not taking usual customary wages for what we do.
yeah.
but But then here's the login for my S corp. Okay, so I got $380,000 in my S corp account right now, and look how many transactions I'm running through there. Okay, because that's my default checking account. That's my management company. That account's got a ton of activity. Okay, so in terms of liquidity, I like to keep. Pre-COVID, I was keeping about $4 million liquid in my business accounts here in Indy, and about $200,000 in my S corp account was my target liquidity ratio. Since COVID, I've kept between $6 to $8 million in my business accounts here in Indiana, just because I feel like there's going to be more opportunities. So I want to be able to take advantage of that additional stuff. Does that make sense? Okay. So, but you saw you need that many checking accounts when you have that many different businesses. When I first met Brittany, what's that called?
PPP.
Well,
What are you talking about?
if you need all those checking accounts,
I don't know.
well,
That is RPP.
RPP.
Well,
Yeah, if you need all those accounts, that's rich people problems. Right?
First world problems. First world problems.
If you're worried about gas prices, then it's PPP.
Yeah.
Right.
Poor people problems. Right? So, yes, it's complicated. Yes, I have a bookkeeper that only does my books. Yes, I spend 150 grand on my personal bookkeeping a year. That's what she makes. Worth its weight in gold. Because she's the one in all those accounts every day, reconciling them. Now, and then I gotta pay $15,000 to $20,000 a year to have her work audited. One of the reasons I like online QuickBooks is that I can give an auditor online access, view-only access. He can get in and check her work and check it against my books, check it against the ledgers and stuff that we have. It sucks that you have to spend that much money on audit and bookkeeping, but I bet half of the theft the people who stole them from me were employees that I consider family members, and then I had 2 family members steal money from me. 2 family members. One stole $100,000, another stole almost $150,000. And, I feel bad for my mom because my family bucket, I mean, how do I go to Thanksgiving at my mom's house? And it breaks her heart because I'm like, is so-and-so going to be there? I'm not going to go. I just can't do it. Like, in my mind, not putting them in jail was the gift, right? I don't hate my sibling that stole from me. But, and I know that, in a perfect world, I'd be able to forgive them. But I'm not going to do it unless I feel it, and I just can't do it. And part of me really does hate. I had friends say to me, Aaron, hate is taking poison and expecting somebody else to die. Okay, I agree, but I still got to find a pathway to let go of the hatred because the betrayal of having a sibling steal from you. I really, part of me hates that person. I wish I could just hate what they did, but Trav was with me this summer. I got a voicemail. Hey, I want to talk to you on the phone and let's talk about what happened, and I want to apologize. And that voicemail sat on my phone for a few days, and then I just deleted it because I just couldn't do it. It wasn't authentic. I'm bitter about it, right? But I have, in the same way that I know that I should be eating those donuts today because that's not good for my fitness bucket, right? Just understanding of what isn't filling your life is the first step. And I'm hopeful I can find a pathway to forgive for that. That would be a big thing for me, right? And so I recognize that, but I'm not doing it if it's not authentic. I just won't do it, right? And now, how many of you, just out of curiosity, how many of you really honestly feel like you'd be able to forgive that sibling? Like, who has that capacity, right? And who kind of is like me, like you don't know if you'd ever be able to get your, yes, 50-50. I find that every month because I felt like that sibling, he unbrothered. The betrayal for me was like so devastating. It was not. I didn't even notice the money. Again, it like fell into my lap the way I caught it. So it wasn't the money. It was the betrayal, right? And so in my mind, like, how do you come back from that? How do you break bread from that? I don't know. Yeah.
What I say is that you can separate the forgiveness from the consequences.
Yeah.
And I ran into that when I was talking to, listened to a guy who was a British officer who had his son get killed by the IRA when they had it in rotation. And they caught the guy who killed us. And he was able to forgive the guy for killing his son, but it didn't mean he couldn't go to jail. He was going to jail. That's the consequence. Yeah. And he was able to move on, knowing the guy was in jail. But it was for his benefit to forgive him so he could move on in his life. I just throw that out as a
Trav could forgive. Trav's very forgiving.
I'm pretty good at it.
I can't let it go.
Well, it depends too. I have a brother that stole $100,000 from our dying grandmother. Right?
Whoa.
Okay,
You forgive him?
I haven't talked to him in 12 years, and I would forgive him if he changed, if he acknowledged what he did wrong, and apologized to the family for it. That's a different story. But he hasn't done that. His comment was, "Well, you're acting like I'm Jeffrey Dahmer or something." It's like, okay. So forgive, yes, if they kind of look like they changed their life around and apologize, but otherwise, no.
You forgive, but you don't forget.
Correct.
That's
Yeah.
all. Yeah, because it's for you, it's not for them. It's for
And
you.
honestly, if he walked in the door right now, I could give him a hug, right? Shake his hand. I won't punch him in the face. I'm past that stage. But to go to Thanksgiving and break bread, ugh.
Could you do it for the sake of your mother?
Yeah, I know. I thought about that too.
You must
I have to do it.
I can't. Actually, I won't. Maybe it's because I'm the oldest son, right? I'm just like too prideful, right? But you see how it's stripped down. I don't even try to qualify it, and I've learned to just be completely vulnerable about that aspect of my 5Fs. Like, I shouldn't. Last night, I was so good with my diet yesterday, and I ate perfect. Trav, what I ate last
Oh my God.
What didn't you eat last night?
Who gave me that extra bourbon when I was playing the piano? Because then I went home and ate like
Crushed Fruity Pebbles.
no. Before that, I had meatballs. cheddar cheese,
Yeah.
and then a bowl of Fruity Pebbles while still drinking bourbon.
And then eat candies.
And then I ate ice cream.
And I was too much.
Oh, God, I felt so sick this morning. All mixed ice cream and bourbon in my stomach. I woke up and like drank like 2 bottles of G2 around 4 a.m. But then I set my alarm. Got here at 6:40 and put 7 miles in. There, you can always make it up a little bit, you know. So maybe I'll get my mom a better present for Mother's Day this year. So and my brother Casey, the smart brother that I named my son after, he's always trained. He's a peacemaker, you know. He just has that. He gets along with everybody. It just breaks his heart because he wants us to all get together for brother stuff, and no, I can't do it. So anyway, something to think about. You know, I share that with you so that you really think about that balancing, because what's interesting is 20 years into this, people say, you know, how did you 10x your efforts from 40K a year to 100 million? It's because number one, I focus on high value activities. I spend 80% of my time on the things that are worth my time, and in this case, it's $1,800 an hour. But number two, mindset. The biggest single factor for me over the last 20 years has been my mindset. It is not special tricks I learned for construction budgets. It is not how I learned. It's not the content. You keep thinking it's the content. If I could learn how to do it, it's not the content. It's the mindset that I wake up with every day. And when Kendall finishes, remind me to show you guys a glow video about mindset, because today I did not want to get on the treadmill, but my head hurt, right? But I watched this. I had this little 7-minute YouTube video that if I put it on, like I was walking at like 1 mile an hour, the video was done, I was like running 6 miles an hour, right? And so I will share that with you guys today, because I don't who's listening to Tony Robbins on YouTube? Okay, I love that guy. He really is the standard in personal development. And I would never even think to try to do a personal development seminar. But I would say that personal development for me has been, 80% of my success over the last 20 years. And then surrounding yourself with a tribe of people who celebrate your successes, who aren't haters, who if you say, I'm going to make a change and do this, and they go, good for you. They don't say, oh, what happened? Well, you didn't see at the gym this morning. They're not that little kind of bitch, right? I hate that person. They'll always try to neg me. That's good. Right? You got to eliminate those people from your life. If they're your family, you just need to minimize it. And if that person, if you're like, I was in Indiana this weekend and I was learning about real estate. They're like, why Indiana instead of, oh, really? What did you learn? Right? Just that reaction lets you know if you need to get that person out of your, I don't break bread with Chicken Littles. I don't do that anymore. Right? When I was in Kendall and I, when we were in Scouts, when I moved from Vegas to New Jersey, I was 11. And so I was in the Boy Scouts in Jersey, and one of the first activities, they took us out freshwater crabbing. Has anybody ever done that? And they have these crab traps that are like these little metal wire boxes, and you put a piece of chicken in the bottom, and then the walls drop down, and you float it down to the bottom off the bridge, and you can watch the crabs come walk in there and grab the chicken, and you pull that string, and the 4 walls close, and you pull this live crab out. And I pulled 3 of them out the first time, and the scoutmaster from Jersey's like, hey, just put those on that cookie sheet. I'm like, they're still alive. He's like, put them on the cookie sheet. He said, they're going to get away. He said, put them on the cookie sheet. I put them on the cookie sheet, and one started running away, and the other 2 grabbed him back. And an hour later, we had a pile of 70 crabs on a cookie sheet, holding each other in. And you all have someone that is that crab in your life. They have crabs. Or I realized all the teachers at the high school had crabs, right? they when I did the first deal, they were like, "Oh, good job, coach. 26 years, doing to make 50,000." When I did the second deal, they had 130. They would only smile with their mouth, like, "Oh, how nice for you." Congratulations, right? And so I learned I gotta eliminate those people. The only employees that I allow to be haters like that in my company are accounting. Because accountings are always Eeyores. And that's why I put them in a separate building. Oh, they're way far away over there. Because I don't want that weird negativity in here affecting me, but it's a real thing. So, anyway, so Kendall's going to go. Now, we're going to put lunches out at some point, and so just feel free to grab one because we got to be done by 2 o'clock today. I want to make sure we're wrapped up, and I want to make sure we have the last half hour, 40 minutes for Q&A. So Kendall's going to go until about 1:15, 1:20, but we're not going to break for lunch. You have to go to the bathroom, go to the bathroom. You need to meet with Meg or someone, just shut up. I want to let Kendall cover as much as he can, and then we'll put the lunches out. Just grab one when they're here. I got to go find out where the hell my donuts are. Thank you. Tracy, what's going on?
Who's supposed to get them?
Hillary, I think there is it. I'm going to find out for you guys. Somebody find out.
Take one for the team. Take one for the team.
I'm just going to eat this one bar. Okay?
Thank you, Aaron. Awesome. Okay, well, Aaron, he's amazing, can you tell? So, Aaron and I, what's it been? Gosh, 5 years now?
Yeah.
At least 5.
No, it's longer than that, dude.
Charlotte. Yeah. It's been a long time. So, Aaron's amazing. Obviously, you can tell. He does not push the limits at all. So, we'll go into tax strategies. We'll cover more detailed tax strategies. But we've been working with Aaron for about 5 years. And I love it. I always learn a ton. So we come here almost every month. Me or my partner, Don Pendleton, you may have seen. And gosh, I still learn from Aaron every single month. It really is all about mindset. It really, really is. I don't know if there's a secret sauce, there's no magic bullet, right? He just figures it out. It's pretty awesome. So we love working with Aaron. I was just to say, so this is one of the properties we bought here. We've got a few properties with Alpine, and awesome job, by the way. If you guys don't have any properties yet, I can say that I'm legitimately investing and looking to do more. And, they did a good job fixing it up. So there you go, right there, nice before and after. I thought it was pretty awesome. We put that's a 5-bedroom, 3-bath, nice neighborhood here in town. So it's been fantastic. We just bought another one a few months ago, and we've had a few more before that, and they've been fantastic. So if you have any questions on that stuff, I can speak to it personally. I actually have been investing in real estate personally for years, and still have my own properties that I personally manage in Utah. And gosh, it's nice to have it passively done. And I don't know how you guys do it, Travis, but the cost difference between me finding my own contractors versus your contractors is, gosh, half or more, night and day. It's amazing. So anyway, I can speak to that for sure. There's a good value there. But so we're Protect Wealth. You guys know Clint Coons there, and then one of our other partners, George Wright, and there's me there. Some of our events. So Michael Bowman was here earlier. He's a good friend of ours too. We do a 3-day training for 20 years. I've been doing it since 2001. We've been teaching asset protection and tax strategies, estate planning. Part of our mantra is, asset protection is good, right? But it's, like Aaron said, it's important to worry, and to kind of make sure you're structured properly so you can sleep better at night. But the main thing is tax advantages. That's the biggest part of it, is tax advantages. But part of our mantra is, okay, asset protection, tax, it's all important, but the main part is, as you can tell, protect wealth. That's why we need to protect wealth. It's because growing and protecting wealth is part of it. Growing is a big one. If you you have assets and you're protecting it and that's it, well, it could be eventually run out, right? So growing it is a big part of it too. So we teach our trainings. That's why we are here at Aaron's workshop. Aaron comes to our workshops. We had about almost 700 people on a workshop this last week that we did.
and Aaron comes and teaches them on real estate. It's part of protecting wealth is growing it. So that's where we shine. We like stock, we like real estate. We bring in advisors, tax planners, accountants, insurance guys. I mean, everything to kind of cover every asset of your financial life. We love it. So that's what we do. You guys may have heard of in the middle there, Scott Estel. He's the former IRS senior trial attorney. So the guy's a heavy hitter. And he worked for the IRS. Now he's come to the good side now. The guy's incredible. He just did a tax comparison. Justin was here. He's not here. Just saw our webinar a few weeks ago. Biden versus Trump tax proposals. Pretty awesome. It's kind of interesting to see. He just made a forecast, if you will. A lot of us are nervous about, okay, there's a $4 trillion tax proposal by the Biden administration coming up, right? So he made a forecast. He says, I had to pick Biden. What's going to happen? He says, don't stress about it, guys. He says, because 2 years, there's another election. That means right now the Senate's in. He does, being at that position at his level, he feels like not a lot will change quickly, but, eventually, slowly, not a lot for us as investors will change. Although I have to admit, the Trump tax laws have been fantastic. So anyway, he will come to our events and teach in depth about the new tax proposals. Pretty fun. And if you want a copy of that, we can send you guys a copy. And then you guys who filled out that form, I could pass out more if you need it. Fill out that form, and I'll make sure, even if you're not going to attend an event, just put your name on it, and I'll send you guys that Biden versus Trump tax proposal webinar. It's kind of fun. All right, so always a legal disclaimer, because we are an asset protection company. This is not legal advice specifically for you. If you need specific legal advice, talk to a professional, right? That's for you only, right? Okay, so tornadoes. We always look at life as there's 4 financial tornadoes in life, right? So income tax is number 1. Who's read The Millionaire Next Door? Yeah, so Bill Danko, good friend of ours, we had him on last week. He's one of the co-author. The Millionaire Next Door, if you remember, that's a book about what makes millionaires. So they did a study, Robert Stanley and Bill Danko, about what makes a millionaire in the United States. So any ideas? Remember what makes a millionaire? What separates the average person from a millionaire? Any ideas?
Saying yes.
I think totally. Saying yes and figuring out later, yeah, that's one. Mindset, totally, yeah.
Tax reduction.
That's it, 100%. So what's interesting, I thought that was really interesting because a lot of us think, it's because, they're a major professional athlete, they're really good at what they do, they invest in stocks, they know a secret stock strategy, or they're really, really good at business, all they do is think business. I'm sure that's all part of it. Mindset, say yes, figure it out later, right? But totally, it's taxes. So what he said, the difference between the average and a millionaire is that millionaires spend an inordinate amount of time learning how to reduce taxes. He says that was the main differentiator. That was the premise of the book. I mean, at the end, the majority was, you can do a lot of different things, but spend more time on taxes. And frankly, most of us don't like to. It's not fun. I'll admit, no one likes to spend time on taxes, but that was the biggest differentiator between the average and a millionaire. So estate taxes and probate, big part of that too. Capital gains taxes, see, those 1, 2, 3. And they are different. And lawsuits. So if anybody's been through a lawsuit, we have a statistic that says the average person is now sued between 5 to 7 times in their lifetime. And everyone's like, no, I've never been sued. No, I don't know anybody that's been sued. Well, do you know somebody who's been divorced? That's a lawsuit, okay? And if you think about it, you probably all do know somebody's been sued at some type of level or another. There's 40 million plus lawsuits in the United States per year, right? And with 350 million population, you can see where totally, there are someone like Trump, for example, has hundreds of lawsuits at any given time, right? Doctors a lot of times have lawsuits going at any given time, very, very frequently in high-risk professions. So yeah, it actually is true, averaged over a lifetime. So let's look at taxes, income taxes. So we like to look at income taxes as toll roads versus freeways. So in life, there are toll roads. Who knows what a toll road is? Does everyone know what a toll road is? Like if you've ever flown into Orlando, right? Drives me crazy because I never carry cash ever, and I don't carry it with me to the airport, right? But you go to those tolls, and it happens to me every time, right? Can you take my credit card? No. I'm like, so what do I do? They're like, well, just drive through. You'll have to pay a ticket later. Every time I swear I go to Orlando, that's what happens to me. Anyway, so toll roads, you got to pay, right? And what do they say when they first put in toll roads? They say it's just to pay for the bridges and the roads and the infrastructure for a few years, right?
Just kidding.
Yeah, just kidding. Doesn't happen, right? For a few years. There's a long bridge between Oregon and Washington across the Columbia River. That toll road was gone last time I went there. I was surprised. So it does happen.
After about 50 years.
50 years though, right? It really was. I think it was like 30, 40 years. Yeah, it really was.
The federal government has to actually sue the state to pull it out.
Is that
in Richmond on the I-95, it was there for too long, and they finally said,
cut it out.
Or we're going to take all your federal.
Yeah, it's crazy. It drives me nuts. So yeah, anyway.
It does happen.
So we talk about toll roads and freeways. Freeways, and I've been talking to my kids. They've been asking, hey, what's a highway? Freeway? Well, a freeway, there should be no tolls on it, right? And so the cool thing is about when you go through toll roads, as a local coming out of the airport in Orlando, I always go with the toll road because I'm in a hurry to get somewhere. But the locals, you'll notice, a lot of times, they know the route around the toll roads, right? Maybe it's, the toll road will save you a couple minutes, but the locals, they know how to get around those toll roads, right? Is that breaking the law?
Nope.
No, right? It's just figuring out things a little differently. Even if it takes you a little more time, you can cost you less. So income taxes are the same way. That's how we look at it. And we look at this is a big differentiator in your mind you need to understand. Tax planning versus tax preparation. What's the difference? Other than thousands of dollars. What's the difference between tax planning and tax preparation?
One's a strategy, the other's just a task.
Reaction.
So one is filing your taxes on April 15th and expecting a refund. Right? That's it. Which is what, frankly, the majority of people do, right? So on April 15th, they file their taxes and they expect a refund, and that's the only time majority of people think about taxes is on April 15th. And I have to say, if that's when you're thinking about taxes, you've lost the tax game. And it really is a tax game. It really, truly is. So tax planning, absolutely, you should be doing daily, right? I mean, don't make it a chore, but just make it so it's automated if you can, right? Just find strategies, and we're going to teach some strategies to tax plan every day, categorize your expenses the right way, right? And it really does come down to categorizes. Who's using a tax app or mileage app? Is anybody using like Mile IQ or something like that? Awesome. I love Mile IQ. That's one of my favorites. If you're driving down the road, right, and you're on business, keep track of that mileage, but some people don't want to write down the mileage. It's a hassle. Mile IQ does that. There's a bunch of them. There's tax deductor, there's things like that. But at the end of your drive, it's all GPS related, right? You stop, it says, was that business or personal? Swipe right, swipe left. It's that easy. It's kind of cool. So there are some cool tools now. All right, so U.S. tax code. So let's go through the difference between personal and business. This is also a mindset thing that you have to think about. When you guys are forming your entities with Anderson or whoever else is doing your taxes, or you're forming your entities, think about taxes this way. Personal taxes. Let's say you have gross income of $100,000, tax at 27%, right? So at the end of the day, you have $76,000 left. Makes sense, right? So your expenses are $70,000, right? Net income $6,240. That's it. That's how taxes work on a basic level, right? So, yeah, that's pretty much most of America right there. And then business taxes. Think about it this way: gross income, expenses, difference $30,000, taxes $6,300, net income $23,600. The difference of $17,360. That's insane. So think about taxes that way. Gross income, the money comes in, you expense it, right? First, you're left with $30,000. You're taxed on what's left. So you have $6,300 tax versus $23,760. So the difference there? That's the difference between a business. This is why Aaron does not want to have his money go into a personal savings account or personal checking account, because at that point, he's taxed at a different level. So if you're having it all go to your personal checking account, you've lost a tax gain. It's at a pretty basic level. That's a major difference. This is why businesses have all the benefits. This is why if you don't have an LLC or a corporation, you're not doing that, do it. It'll make a difference for you. Find ways to do tax strategies. And a business is one of the most key ways. We feel like everybody should have a business. Even if you're W-2 employed right now, find a way to do a business. You'll find ways to, your cell phone, can that be personal or can that be business, right? Can you write that off? Find ways. Your internet, I don't know anybody who can't do a business without internet, right? So find ways to deduct it. All right, so no business, you earn it, pay the taxes, and spend what's left. Business, you earn it, spend before taxes, and pay taxes on what's left. That's that in a nutshell, but it's a mental mindset for sure. All right, so medical expenses. We're going to go through some different expenses you guys can deduct things on. This is IRS Section 105. You guys notice on each one of the slides, we do cite the section, so don't take my word for it. This is all in the tax code. One of the things about the tax code, it's, I don't know how many thousands of pages, but nobody understands it, right? So the thing is, IRS Section 105 is there, and you'll find out a lot of times those thousands of pages of taxes, if it doesn't work here for deductions, it might work on page 5,000. You know what I mean? It's in there somewhere. There are ways to do it. That's why it's all relative sometimes. Yeah.
The question on herbs and supplements. So can those be reimbursed?
Yeah. If you can get a prescription.
I said you got to get a prescription.
Yeah. So, a lot of the IRS rulings, come down to what's reasonable, right? And that's why sometimes, I don't know, you don't call it a gray area, but it really kind of is, because it comes down to someone's opinion. A lot of the tax code is not necessarily black and white, right? So if you can get a prescription, yeah, it's reasonable. Yeah, totally, yeah. So these are medical reimbursement plans for your business. Totally, if you're not doing this, everyone has healthcare expenses. It's one of the major expenses, that everyone has. This is one of the major reasons you want to set up a medical reimbursement plan. I think why Aaron's going to look at doing corporations, because you can do a lot of these. Yeah, it's interesting. We look at air conditioning. Well, some people definitely need to be cooler, right? It makes sense, right? Is that reasonable? Maybe. Right? If your doctor says your house is too hot and you're not healthy, air conditioning, seriously. Even we've seen people do pools before, right? If that's good for your health, right? I mean, what's reasonable? It sounds kind of tongue-in-cheek, but it really is true. If it's reasonable, look at it for sure. Mileage to and from the doctor's office. Did you know you can deduct that? Pretty cool. Keeps track of your mileage to and from the medical visits. Vision, chiropractic. So kind of cool. Even special foods, which is interesting. Yeah.
With things like gyms,
yeah,
memberships.
Yeah, we've had, we've seen people do like treadmills and stuff. Yeah, gym memberships for sure. That's part of health.
But would you have to have a prescription or?
Yeah, it usually helps. You want to have some kind of,
medical reason.
Yeah. Well, I mean, if you're a medical professional saying, well, exercise more, here's a good exercise idea, in writing. I mean, I think we could probably all get one a treadmill. We probably all need it, right? Okay, health savings accounts. So this is kind of cool. Aaron just touched on this a little bit. So these are your limits for 2020. So kind of cool. Family, $7,100. Awesome. We talked about HSAs, and you guys know that, and Aaron covered that, you can invest from an HSA account. So if you have money left over and it's not used towards medical at the end of the year, you can invest that money too. And that's where IRA Club is fantastic. So if you want to invest in some stocks or real estate with your HSAs, that's now possible. So IRA Club does do that. So make sure you putting money in HSA. That's a great way to do it, tax-free. All right, so, yeah.
The HSAs are only apply if you have a
high deductible plan, right?
Yeah. Yeah, and what is, I don't forget the exact number, it's like, 2,000 or something like that, but yeah, it's, it depends on family versus single, but yeah, high deductible plan for sure.
So those medical
2021, I think it's up.
insurance for business,
What was that, sorry?
that the medical expenses write-off, is that if you get through insurance through business?
Yeah,
So
generally.
not through your job.
Yeah, and then there are some ways you can do it too. If you're paying premiums and stuff, you can write those off too in some ways.
Okay.
Yeah, make sure you're looking at that at least.
It's open enrollment, so I think for 2021 it's 72 and 82. I know that.
Oh, good, nice.
So it's
Okay,
up,
good.
It's up $100.
Good.
Because we're
$100. All right.
at least in the family and family over 50.
I'm impressed. Good job.
But I don't know what the other.
$100. Hey, it goes up every year. That's good. That's impressive. Good job. All right. So, yeah, exploiting children. No, that's not what we're doing here, guys. So this is my baby Addie. She's my model. So yes, we do pay. I do pay my kids, right? They don't know about it, but it's a good way to write off taxes, right? So $12,200 for your business. So look at that. Look at the difference, though. This is those new tax laws came into effect. This is kind of what the Trump administration did. In 2017, it was only $6,300. Now it's $12,200, almost double. So kind of cool. So if you can find ways to pay kids for accounting, bookkeeping, trust me, my algebra, almost 13-year-old daughter, I guarantee she can do Excel. Sometimes better than some people we work with. Anyway, I guarantee she can do it, and she actually loves it. Collections, office cleaning, for sure office cleaning. We actually have kids do that a lot. That's great. Sometimes it ends up messier, but we do our best. Equipment leases, that's kind of cool. So if you can do, you set up maybe an entity for your child, and you put equipment into the entity, right? And lease it back and pay your kids for equipment leases, right? Kind of cool. So if you have equipment, computers, things like that, maybe, a lot of medical dental offices have a lot of expensive equipment. You can lease equipment from your kids. It's kind of a cool way to do it. Office morale, that makes sense, right? That works, right? Social media consultants, like Aaron said, they know a lot more about social media than I do, and I cannot believe how fast my 12-year-old's figuring that stuff out. It's scaring me to death. I'm taking away that phone. Image licensing. So like Aaron said, babies, if that baby can get paid a royalty, that's my baby Addie. She's now 2. Cutest thing ever, but totally. That's my baby. She's getting paid for this. Thanks, guys, for being here. It helps her out. It's awesome. All right, and royalties. So a lot of different ways to be creative and pay our children. So think of ways to do that. $12,200 for your business. Awesome. All right, so in 2018, $6,300 to $2,200. These are Roth IRA contributions. That's right, we did do those. So education savings accounts, birthday presents. Oh, this is good. Christmas presents, birthday presents, scout camps. How does that work? Pretty cool. So, those expenses add up. So if you want to pay for Christmas presents, is that reasonable from a tax perspective? How can you do that? Right? Is that reasonable and necessary? Maybe not. But if you have, your child working for you, and you want to, what we do is we get them a debit card from their business entity, right? Or the Roth IRA, things like that. From their business entities, though, you have a debit card, right? And you can. They bought themselves Christmas presents sometimes, as nice ways, birthday presents, nice ways to bonus them, right? Band camps, scout camp, things like that. Those are absolutely ways you can use their accounts if they want to do something, a way to reimburse themselves out of their account. So kind of cool. So totally think about it. Entertainment, absolutely. These are, if it's reasonable and necessary for you, your business, your family, totally. It's within reason, absolutely. All right, so now taxes come down. How do you actually see the expense? So what is that, ladies?
Louis Vuitton.
Oh, Louis Vuitton. See, I didn't know that. So, is that what that is, Tracy?
She said it's a brief.
There you go. That's a computer bag. That is not a purse. It's a briefcase. It's a computer bag, right? And you've seen those little, tiny little bags sometimes. They fit cell phones, right? Do you need a cell phone for your business? It's how you see the expense, right? All right. So absolutely, cell phone fits in there. So that it works perfectly. It's how you see that. What's that? It's not an HD TV, guys. That's a computer monitor, right? And you believe it, some people for their business need really big TVs, right? And I will say, more than ever, this absolutely applies. We do all of our events almost this last year on Zoom. And you should see, if you get pictures from some of our students, they got their big TVs on and they're watching their business events on TV. This absolutely applies more than ever before. Totally reasonable, right? So don't buy TVs, buy computer monitors, right? All right. And we talked about businesses, right? Is that a vacation? A cruise? It's a business trip.
That's office morale.
That's office morale. Absolutely. And there's a lot of truth to that, for sure. All right. Is that a nice personal dinner, or is that a business? It's a business deal, right? Business trip, right? Absolutely. So we look at business trips, and that's publication 463 if you want to look into detail. Love it. Absolutely. So this is Britt. She's not in there. This is Brittany with her hubby there. We went to Alaska last year in August. Coolest trip ever. Seriously. I'm telling you guys in Alaska. I loved it. Next time. Come on. Let's go. I would tell you, if you haven't done a business trip to Alaska, do it. Aaron, we've done some cruises with. So we've done a few in the past. Him and his kids there. This is Brittany speaking on our cruise ship last time we were there. So we did a cruise ship, Ovation of the Seas. If you haven't done Alaska, just do it. It's so worth it. Seriously. Tax deductible, tax write-off, do it. So, yeah, good group there. This so much fun. Oh my gosh, it's beautiful. Seriously. So stunning. But is this workshop tax deductible? Is a cruise tax deductible?
Yes.
You know what's interesting? A cruise is not. So you cannot look in the IRS code and say this is tax deductible. There's nothing that says a cruise is tax deductible. But what it does say, read this: if you travel by ocean liner, cruise ship, or other form of luxury water transportation for business purposes, there's a day limit on the amount you can deduct. The highest federal limit for luxury travel in the table. So it says, if you travel by ocean liner, cruise ship, or other form of luxury transportation. So what we do is we set up a business meeting offshore every time we go.
There you go.
I forget which port we did in Alaska, but we did one off port. Every time we go, we pick the furthest port, and we have a business meeting off port. So if you take an ocean liner, cruise ship, or other vessel to get there, you can deduct, and these are 2019 dates, limits. They're not much changed, I believe, for 2020, but yeah. So we went in, June through September 30th there was $798 daily limit. That's the maximum you can deduct per day, per person on a cruise ship. Is that crazy? And that's in the tax code. So kind of cool. So you totally can. So cruise ship, no, but a business meeting, yes.
Did you have to have meetings every day?
No, you don't have to. No. So if you use it to get to a business meeting, right? Like your plane ride to a business meeting, tax deductible. A cruise ship, sometimes when we do our cruises through Protect Wealth, the only way to get to our business meeting, you have to ride the cruise ship. That's it. That's the only way to get in. So that's how we do it. So it's a transportation to and from. If you look at transportation to and from, figure out there's some pretty cool stuff you can do.
Can you have meetings while you're in transit?
Sure. Yeah, that's what we're doing here. Yeah, we have a lot of meetings. So we have meetings on the ship. We do. We like to, but it doesn't make a difference though. It has to be transportation to and from. So this is on the tax code here, publication 463, page 9, 2019, probably different 2020.
So if a group of friends want to take a cruise and meet at a restaurant way far away and the business night meeting, then all that can be deducted.
Yeah, so we had Scott Estes look at this. Again, he was a former senior trial attorney at the IRS. Absolutely. Yeah, we have to look at this very carefully to make sure we're within reason. To and from, it's in the tax code. Thank Congress for that one. Oh, okay, so these are the restrictions, right? They have to be one of these places, but everywhere we've wanted to go is pretty much in one of these places, right? A lot of them go through Mexico and the Caribbean, right? A lot of these islands, the Caribbean. These countries are like Hawaii, right? USA, Alaska, USA. I mean, so, you know, it pretty much hits most itineraries hit one of these places. I wonder why. Imagine that. All right, yeah, so we always say, what's going on over here? Board meetings, right, guys? Board meetings happening everywhere. So that's how you look at your business travel. These are all board meetings. This is one of the ones we did in Honduras. Pretty cool. So, I don't know. I think that's reasonable. Aaron says he's wearing flip-flops for a reason, right? I think it's reasonable to have a board meeting in the pool there, swim-up bar. I don't know. Think about it. It's kind of fun. All right, home office. So Aaron did mention this one too. Home office is one of the things in the past a lot of people have had problems with. You know, a lot of accountants, CPAs, they're really nervous about that because your audit risk goes up. That is not the case anymore. Gosh, if COVID hasn't changed that, I don't know what will, right? Everyone's got a home office and everyone's home now. For sure. It was reasonable before. Now I don't think we're going to have any questions. So if that's in your mind at all, home office is 100% a possibility for you. I like the home office a ton. You know, Aaron does his whole house. You guys know how the home office works, right? So if you have for simple math, 1,000 square foot home, your office is 100 square feet, that's 10%, right? So you can write off 10% of the mortgage, right? 10% of utilities, right? I don't know. And I think a lot of it's reasonable to do, you know, 100% of internet, you know, for a lot of the businesses. That's the majority use, you know, if it's reasonable.
If you say 10%, that's 10% of all those categories of
correct. Everything.
Property.
Yeah. Isn't that cool? It's a big deal. It adds up a ton. So make sure you're doing that. If you're not in a home office, that's a big one.
What about like improvements to the home? I put in wiring for cameras. I put in the new fence.
Yeah, sure, absolutely. And if you have ongoing costs, you can. But a lot of that, yeah, we'll talk about in a minute. It's kind of the cost seg kind of type stuff.
Okay, so you wouldn't take 10% of those.
Gosh, if it's for your business, you can do 100%. I mean, you know.
Okay.
You know, if it's for your business.
Yeah.
Look at me. Well, there you go. See, I don't know. Yeah, home security.
Most of the fence can be security items.
Yeah. I mean, it's for your business. If you're getting it for your business.
Well, a fence could be landscaping.
Well, landscape maintenance.
There you go.
But the cameras.
You want to make sure it looks nice. If you have people coming by, you know, it's, you know, you do. It's reasonable.
Yeah.
This is not, no longer is this an issue for a lot of CPAs, accountants. It's not. So if you got one that's having a problem with it, probably switch. All right, so this is nice too. This is a big one. People like to use this. Rent your home, 14 days per year. You know, I'm in Salt Lake City, so the 2002 Olympics, gosh, people made a killing. You guys know there's different functions that come to your state or city, and you want to rent your home tax-free. 14 days, so 2 weeks per year. That's pretty awesome, right? Rents must be reasonable. And gosh, you know, like my partner Don, when they had, you know, 2002 Olympics, they made a killing renting their house out. And it was reasonable to charge, you know, $5,000 a night for a lot of them. Seriously. So, yeah, corporate board meetings, staff retreats, office parties. Look at renting out your home 14 days per year. Big deal. That adds up in a hurry too. All right, so this is interesting too. If you have an accountant, a CPA that is telling you cannot write off your cell phone because it's not used for business, that's bogus. This is in the tax code. What it does say is you can't use your cell phone for business. That's why there's confusion there, because if you look in the tax code, you can't use a cell phone, right? Look at this, IRS notice 2011-72, 2011. So remember, you have the tax code and you have tax rulings, right? Which then come into play. So what happened was the tax court ruled that business can provide a cell phone for an employee and it's a non-taxable fringe benefit. And the IRS does not require record keeping. So if your accountant's telling you that, we find that all the time. I can't, it's not for business. Well, it's not in the tax code, but it's in the rulings. So anyway, it's there. Yeah.
Receipt-based compensation, like the expense.
Yeah.
Yeah, that would be fine for
Yeah.
cell phone.
Yeah. We've done that a lot. Yeah. Totally. I don't know any business that doesn't need a cell phone these days. I mean.
No, absolutely. But they separated the data. My company separated data and the phone for some reason.
I mean, if it's reasonable for your business to have data, mine does.
Yeah.
Yeah.
So if you have like a family plan with a bunch of cell phones, you just take 1/3 or 1/4, whatever. It's like my phone that's
Unless your family's part of the business.
that's
Reasonably.
that's not in the
But
law.
yes,
In the
you
law.
separate it out. Yeah. You separate it out.
Work towards the other.
Yeah, work towards the other. Yeah, for sure. All right, internet, of course. We talked about internet. That's a big one, too. If you have internet, I think data on your phone, it makes sense to me. A lot of you have social media. You kind of got to deduct internet. I mean, that's totally reasonable in today's world. Zoom calls every day. Mileage log. Okay, so these are 2019 deduction rates. Again, if you're not doing, something creative on mileage, it's a big deal too. This adds up. You'd be surprised.
Getting back to the deductions.
Yep.
So, what's deductible from the standpoint of, let's say, you need to be up on the latest market trends in real estate, and CNBC, of course.
Totally.
That comes through DirecTV.
Well, there you go. Is it reasonable for your business?
Yes.
Yeah. I love Aaron's thinking because your accountant will say, no, that's, your accountant's, again, very conservative, probably just says there's no way because they're so conservative, they're sticking their neck out by saying yes, whatever, right? What's the worst that's going to happen? They're going to say no and not allow it? So what? You know what? I'd try it. Yeah, I love that. I love Aaron's attitude about it because try it. You never know. I mean, it's not like you're being dishonest about it. It really is legitimately for your business. Reasonable? Totally.
Home building trends and all this stuff.
Totally. Yeah. I love like
so
Warren
happy to get a bunch of other channels.
Yeah. It comes along with it. You can't separate the package. I know that's true. I've tried. You can't. I know. It's totally reasonable. I love it. I really do. It's true. But mileage is a big one. So if you're not used to a program like Mile IQ, guys, think about what's business and what's personal travel. Every day, every time you get in a car, that app will run. It's pretty dang sweet. It runs GPS based. Is that a business trip or is that a personal trip? So if I drive to my office every day from my house, is that mileage business?
Business.
Or is that personal?
It depends.
Yeah, well, it kind of depends. So they actually say, it's kind of true, they actually do have a ruling. You can't say, I'm driving from my house to my place of work. That's not deductible, right? That's not mileage, that's deductible. What's interesting though,
8 to 5.
so it's from, where the mileage starts is from your first place of business. That's how it works.
Home office.
So if you're driving from your house, your personal house, to your office, that's not. If you're driving from your home office to your business office, I don't know, whatever, right? Which that's what I do. I have a home office and a business office. And if you don't, like one of our partners, Pat James, you've heard him. I love that. He basically has the closest P.O. box to him, or what he does, which is like a mile from his house. He drives to the P.O. box to check his P.O. box. That's his first place of business for the day, right? And then he drives from there to his office because he doesn't want a home office or whatever, right? There's just creative ways of doing things. And is that reasonable or necessary for his business? 100% it is. But it's how you do it, right? And sometimes it's inconvenient, but you're going to save a lot of money. It is. So it's kind of cool. Yeah.
That first trip, do you ignore that first part from your house to the P.O. box?
Correct.
Okay.
Yep. It starts from the first place of business. Yep.
If you stop for coffee on the way there, is that a marginal line? I mean, I'm just curious.
So if it's personal, no. If you're, anything 24 hours of business meeting can possibly, So, but no, not really. I mean, you stop for coffee on the way. I don't think that matters. I mean, You know, it starts from your first place of business, mileage to and from. So you stop on the way.
You stop at the coffee shop a half a block from your place.
It's reasonable. Yeah, it's reasonable.
And
Yeah.
They don't track my tenths of a mile, do they?
I think they do.
I think the app rounds off to miles.
Yeah.
My app rounds off to miles.
The Mile IQ?
No, I'm using Everlens.
Okay. Yeah, I just look at the apps. I think a lot of them do.
The IRS doesn't say you have to take the most direct route either.
That's right. See? Justin's he knows what's doing.
Do you have to track the odometer or just the mile?
No, this keeps records. It actually is a legitimate GPS point coordinate to another GPS coordinate. You have record of it.
Right, but do you have to do the actual odometer reading? For
No.
each trip or
Nope.
anything? Like,
Nope.
give
Maybe you took a bike.
mileages from point A to
Yeah.
point B.
Maybe you rode your bike. There's no odometer there, you know? Seriously. Yeah. All right. Okay, clothing. So I love this. So is clothing deductible? You notice this first picture, they've got a logo on their shirts, right? So if it's for business, for sure, right? I love it. So, and I love this picture. She spilled coffee on her shirt, right? So if I'm here and I'm sloppy like I sometimes am, and I spill on my shirt, right? Replacement cost, right? Replacement cost. And that absolutely, it happens, right? So it just depends on how you look at the expense. It really comes down to that every time. Advertising and replacement cost. Again, publication 535. It's all there, guys. All right, entertainment we missed. You guys know entertainment no longer is applicable. No longer meals. Entertainment, it's just now meals. So keep that in mind. Entertainment's gone. I think that was part of the give and take, right? That the Trump administration had to do a little bit. We'll give a little bit, take a little bit. That's probably what happened here.
So like, just like a business meal.
Yeah.
So between members of your team.
Yeah.
So that's more now.
Yeah. Let's go. I just want to show you this one real fast. So meals. So meals, here's how meals work. So you have to be in travel status, you be deductible, right? Business purpose, right? This is where people get confused. Business purpose. So, okay guys, let's go to lunch and we'll talk about business. All right, they don't care. The IRS does not care because you talked about business. That was it. So what if I'm here and, we want to go do lunch together, right? But suddenly, I've got a book at the restaurant, I'm going to go eat there, you don't show up for some reason, you can't make it. But our intent was, we're going to discuss a real estate deal. Is that still deductible? But I didn't talk business though. My wife and I had a nice dinner or something. Was that still deductible? It is. Your intent, it's all on your intent, right? Right? And that's not to say that, like I said, gray area leaves it open for fraud or whatever. It really was, we intended to meet one-on-one to talk a real estate deal. That was our intent. So that's what it comes down to, your intent. So business purpose, per diem's cool. This is interesting, guys. So I don't turn in my receipts anymore for business meals anymore. I don't even worry about that anymore. Here's how you do it. It's a cool way to think about it. Per diem. So like I said, don't turn in my receipts for my meals. Don't care. I pay myself per diem every time I travel, right? And you guys know every city has a different per diem rate, right? I generally pay $50 per day to cover my expense. Some cities are higher, some cities are less, but average out about 50 is generally what we do. And I can usually eat for $50 or less per day, whatever, right? So pay yourself per diem, write that off instead. See? Don't have to worry about my meals. Unless you're paying a big meal, no big deal. All right, so catering and gift cards. So, all right. Catering, 100% deductible. So that's pretty awesome. And gift cards, love it. Gift cards are a great way to go if you want to have a business perk and you guys want to take people out to dinner. Do some gift cards as a bonus. There you go, to nice restaurants. Dine out. So if you go out to dinner, guys, if we all went together to a restaurant, sat down and ate, 50% you can write off. Catered, 100%. So Aaron brings in food here for a reason, right? 100%. If you get pizza delivered, 100%, right? Sometimes if you have the meal catered, you have someone get the food for you, bring it in, catered. So I guess they don't want you in the restaurants, clearly. It's kind of weird. right? So think about this. When you're doing your business meetings, dine-in versus cater is a major difference.
Can you go back to that last slide? I just want to grab.
Sure.
Thank you.
Yeah.
Hold on one second.
No problem. Go ahead and feel free to take pictures, guys, if you want to. I'll go back and listen to you. I want to cover this a little bit. So a lot of this, a lot of you have asked or have been on coaching. You've purchased coaching program, mentoring program, real estate investing programs, real estate education, stock education. So are those types of educational packages, are they tax deductible?
Of course they are.
Depends. Actually, you got this down. It depends. So, okay, guess what? The only time a educational package training course is deductible is if it's required by your business, right, for your job, or if it's an accredited degree from an accredited institution. So like I put up here, Kiyosaki's program, a lot of you guys know, they're not an accredited institution, so that's not going to qualify. Okay? So how do you write off those types of expenses? So a real estate training package,
R&D.
research and development. You're smart. Man, I'm amazed. So research and development, guys. So if you're going to start investing in real estate, should you research real estate? Should you take a coaching package, a training package? Absolutely, right? You should be smart about your investments. And you absolutely, that's why we do like training, the coaching training packages that Aaron offers or Kiyosaki's offered. A lot of you have done those. Absolutely.
But listen, okay, I got that. So we're obviously all real estate investors, or
yeah,
we're also coming to Indianapolis to evaluate real estate.
Totally.
Right on.
Yeah.
Correct?
Yeah.
Okay.
Oh, for sure. Yeah, for sure. Yeah. See, that's how you think. I like it. Absolutely. Your travel to and from, trainings, classes, courses, hotel stays. Absolutely. No doubt about it. That's why you see, we've had this conversation with Aaron. He used to not put anything on his personal cards or anything. My partner Don says, you kind of got to do at least something, So he's been doing a little more. You saw he's only got $8,000 in his personal account. Keeps it very low. Because he thinks everything he does is a business expense. Awesome mentality, right? And he's been audited and, he pretty much, he wins.
So basically, if we have partners, we go to the spaghetti factory.
Cool.
Discuss the training.
Yeah.
Then that's 50% enough?
Correct, if you go out.
I just want to.
But if you had
If I had it delivered to the room.
if you had some of that Mazeppa cheese, which I love at that spaghetti factory, so good. Deliver it in, right?
Yeah.
If they brought it in, 100%.
Oh, shit.
It's weird, isn't it? It's weird.
So because there's so many entities like Dash or
Yeah.
DoorDash, all that, does that
Catering.
include into the 100?
Totally, that's catering. Absolutely. Grubhub, yeah. DoorDash. Weird. I mean, you can do Wendy's now, right? Whatever, right? It's amazing. It's cool. We do a lot, actually. So any questions on R&D? You guys understand that? So if you have a training or package, it's research and development for a business. That's a big deal for a lot of you guys who know who've done education and training. So keep that in mind. It's a big deal. All right, covered meals okay. All right. Yeah, by now, 50%, catered 100%. DoorDash. Good way to go. DoorDash? Nice app. It's a great thing. All right, so this is important. Take a picture of this one too. Most commonly missed real estate deductions. This adds up, guys. So, if you're all real estate investors and just getting into it, keep an idea of these. These are something your accountants, your CPA should be paying attention to. Yeah, really, these all add up. Tax preparation, snow removal, lawn care, all that stuff. You guys can usually think about that. Association dues, people miss that one a lot. Wages to children and grandchildren, don't forget that. So, a lot of different things there. Got it? Go ahead. Go ahead.
I was keeping them out.
You're fine. It's interesting though, because there's a lot to think about, and I get it. Unless you have a good tax preparer or CPA doing this for you, you're going to miss a lot of these. So they add up.
So I got another question for you. So so basically, if you've got two business partners going somewhere, and you eat out, it's better to do it per diem.
That's what we do. I like it because it's easier.
It's easier, and you can pretty much generally cover everything.
I think $50 a day per day. It's reasonable. That covers most meals, I think.
So is there a way, where do you find, like, if you're traveling different states to get somewhere? Like, how do you know, like, in Indianapolis, what the rate
Per
is?
diem rate, you can just Google it.
Okay.
And it's all there. They have per diem rates for every. So you just type in per diem rate Indianapolis. It'll show you. I don't even know what it is here. We just do $50 kind of as an average.
Okay.
But New York's going to be higher than, here, South Dakota, right?
Not that you would get, I mean, that would make up for the 50%.
Mm-hmm. Yeah.
There's a website called gsa.gov.
Okay.
There's a bunch of zip codes. We'll tell you how much it is.
There you go. Yeah, so that's even easier. There you go. GSA.gov. I didn't know that. That's good. Yep.
Is the per diem only good for when you're traveling?
Yeah.
And then you use the catering for when you're
In the office. Yeah. Yeah. Perfect. Yeah, you got it. All right. So let's go and look at some detail on properties. This is one of the properties in Alpine. This is not one of ours, but if you got to look at them yesterday, kind of cool. I love Alpine. They've opened my eyes to real estate. So all-in cost for the property $82,500. Land $20,000, building $625, all-in cost $82,500. The turnkey property, one and done, right? So let's look at and see if we did, depreciation standard, $2,273. That's all you got for depreciation this year, or 27 and a half years, right? That's it. So not a big deal. So, but with the new tax laws that came out in 2018, kind of cool. So same all-in cost, $82,500. Except for, here's the difference between improvements versus repairs. Okay? Here's the difference. Tax impact depreciation goes down. Instead of $2,000, it's now $1,000. But now because you've got the building improvements, now you can write off $33,000 this year. That's where the 2018 Tax Act changed things, right? That's a big difference. $2,000 versus $33,000, right? That's a massive difference. So Alpine does a lot of these properties too. They always have. If you talk to them and say, "Hey, I want to do one that has improvements," they can kind of write that in as a line item for you. So they always have properties that have improvements, right? So Aaron covered that. Improvements versus repairs. You want to have repairs, right? Repairs are better. Improvements, not so much. And Aaron likes to go everything repairs. I don't know. What's reasonable? Yeah.
Maybe I missed, sorry, I didn't launch, but is there a way to help minimize the taxes on, let's say, a flip and all the inventory that you're putting into the...
Totally. Yeah.
How do you do that?
So that's the same thing. So you want to put in repair costs, right? So there goes into your repair costs.
Repairs, as opposed to usually categories.
Yeah, so you don't do improvements, right? The building cost doesn't count, improvements don't cost, but repairs do. All that inventory, all those expenses go into repairs of the asset.
Okay, so then it doesn't get counted as inventory?
No. I don't think you'd want to do it that way. I guess it depends on your accountants do it, but if they can take that from a inventory to a repair, then yeah. I guess it depends on how you're doing it. But yes, if you want to categorize a repair, later, totally fine. Does that make sense?
All the materials and everything?
Yeah.
Okay, great.
Totally, yeah. That's part of it. That's where the costs come from, yeah.
Can you deduct anything off of Roth IRA? Any of the repairs, expenses?
No, because it's tax-free. Tax-free in, tax-free growth, tax-free out. It's a beautiful thing. So there's your benefit. Yeah, I wish. Yeah, it's just, that's why you do the Roth IRAs, because they're easy, right? And by the way, for asset protection purposes, IRAs are very strong for asset protection. So they're great for asset protection and the best for tax. You don't have to worry about any of this. Yeah. If you're buying an IRA, none of this applies. We don't care. Aaron talked about cost seg. This is really cool. We work with a group. It's amazing. 2 years ago, they would not do a cost seg analysis. They send an engineer. So I don't know if you don't know about how this works. They send an engineer who comes and looks at the properties, right? And they look at what's the countertop, what's the wiring, what's the carpet, what's, the fixtures of the property. They look at everything, and then they do that analysis, and you should be able to save a lot of money based upon, their analysis. And a couple of years ago, it didn't make sense for them to do anything under like $200,000 properties, Now, because the new tax law makes a lot of sense, cost them, $1,000, $1,500, $2,000 to come out and do analysis. It just didn't make sense on a lot of the properties for them to come and do it. Now their engineers will go out to anything like $50,000 or more. So it applies to most of these properties here in Alpine. A lot of these companies will now come out and do the cost seg analysis. You have to get in line though. They're pretty busy. But a lot of the companies now, totally, anything Alpine, anything, Charlotte, Kansas City, a lot of them will do that. And it'll save you a lot of money. So now instead of having to do the analysis that it deducts over 29, 27 and a half, 39 years, you can take it this year with the cost seg analysis. Generally saving you 30% on average per property, right? This is the different types of assets, right? But on average, about 30% this year on the purchase of a property. Pretty awesome. So if you are not doing cost seg at all as part of your real estate investing strategy, you're losing 30%. Seriously. So make sure to look at that. Find a good company if you want help. Aaron's got a company. We have companies. They're all over the place. But all right, QBI, yeah. So 20% of your rental income. So this is a big deal. So a lot of you guys probably already seen the benefit from this last year's taxes. QBI is huge, right? So, service businesses type, right, to be qualified. Just keep good records, basically, qualified. So, track the time you spend. Like Aaron said, 750 hours to be considered a real estate professional. You may or may not want that, for tax purposes, but that's your personal tax level. You may or may not want to be considered a tax pro. Maybe just passive is better for you. I don't know your taxes, but yeah. Go ahead.
Does QBI phase out with some income level?
Yes. I don't know what level it is.
I think it's 415 or something for very found joint.
Yeah.
It's high.
But okay, so we don't worry about that. I guess the reason why we don't worry about it too much because, that's if your W-2 income, getting paid a pretty hefty income. But if you've got several different businesses, right, and your income's $1 million, well, we're not going to show $1 million income, right? All right? So our goal is to always not show that income. So we don't really run into that as a problem. But you're right, it can be. Yeah, if your W-2 income is pretty high and you don't have a way around it, well, you're right, Justin. It's totally right. We try not to run into that as a problem because it's your business, hopefully, right? All right, so you just keep good record. It's basically QBI. Own the property in an LLC, separate bank accounts, keep receipts. It's a big deal for you. All right, so we've covered a lot about IRAs this week already, but this is the max you can put into your IRAs. If you aren't looking at this is so good. I'm surprised how many people just think, well, the maximum I can put in is to an IRA of $6,000. Well, that's true, right? But gosh, when we do a set plan, my partner and I, you can put up to $57,000. So it's 25% of your income in the business. You can put that up to $57,000 this year into a separate IRA account. So never limit yourself to $6,000. That's not going to get you very far. But set plans are fantastic, simple, 13.5. Defined benefit plans, we just did one a couple weeks ago with one of our partners, $230,000. So you're not limited. There are certain exclusions, restrictions. If you don't know about these strategies or have someone who can do it, and they just think 6,000 is your limit, you're missing the mark. You're missing the game. You need to go get someone who knows how to help you set up a set plan. Because $57,000 a year into a tax-free environment, huge, 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 huge. As long as you're playing the game right, it'll add up fast for you. Okay, so a little bit about dealer status. This is why I mentioned it. So this is kind of a big deal. If you are investing in your personal name or as a sole proprietor, right? So maybe you just started investing in real estate. You decided, I don't want to set up an LLC. Too much hassle, too much cost. I don't care. I'm just going to take deductions. You then basically are a sole proprietor, right, in your own name. That's what you are. or an LLC, right? Excuse me, or a partnership, not an LTEX, but a partnership. And after this, you and a partner go in and do a property and do occasional trades in real estate. What happens, it's a big deal, guys, if you're just doing your own name and not in an LLC. Here's why. Because if it's in your personal name and you are doing occasional trades in real estate, you can be defined as a dealer, and you don't want this, right? So you be loss of long-term capital gains rate, loss of depreciation deductions, lose the ability to do 1031 exchanges, pay Social Security tax and all income, and sell deferral. So and often 50% plus federal taxes on flip income. So this is where for 3 years or more, if you are defined as a dealer because you did not set up an LLC or you did not do a corporation, that's a problem because you can get defined as a dealer. It doesn't happen too often, but you want to be very, very careful. It's another reason why we like LLCs, right? Or limited partnerships or corporations, some type of entity to keep you personally separate from the business. Any questions on that? Does that make sense? Good? Okay. Big deal. So that's why we like LLCs. Okay. Scott Estel, I'll send you guys that if you fill out that card. Anyone needs one, I got them here. But fill out that card and I'll send you guys the latest webinars we do with Scott. Fill it out there. Our workshop, just a quick break on our workshops. This is, again, because of COVID, we're going to be doing everything live stream right now. The hotels we usually do it at aren't really open, or if they are, it's like 50 people. It just doesn't make sense, and you're spread like literally like in Vegas they would do it like 10 feet, and they came around and security enforced the masks and everywhere, so it just didn't work for us, guys. But so we'll do some of these. Fill out that card, and we'll send you, if you can't make those dates on this card, just put TBA, TB determined, and we'll get you guys an email. All right, so I always like to ask, why didn't your account and your CPA, why aren't they finding these deductions? What's that? Yeah, it's interesting because a lot of account CPAs, again, they're very conservative and they don't find them. It's really, it comes down to, this is why we like the education piece. This is kind of why you guys are all asking, how we work with Anderson. They're basically partners. They're at all of our events. They actually do the legal work, their firm, but we've done the education piece and training, for 20 plus years. We have this event we do, the 3-day Asset Protection Summit, is the longest running event that we know on asset protection. The founder was Jay Midden. He started back in the 70s. And doing asset protection and tax kits. And this is kind of where we shine. We like to make sure that you understand the tax side. It's important to understand the nuances because even if you have a good tax planner or a good tax accountant, do they care as much about your money as you do? No. They don't. This is what blows my mind. You guys know who knows the most about taxes? More than anybody I know, Aaron. He knows a ton. You can't tell. The guy knows the nuances because he's a smart investor. Could he hand it over to someone? Sure, but I guarantee you wouldn't be saving as much money on taxes because he knows the details. It's important to educate yourselves because no one's going to do it like you will, right? So that's why find good time to educate yourself on these. Yeah, so it's how you categorize your expenses. It's how you turn in the expense, right? So if everything you do is just dine in, you never know about doing, catering, well, that's 50% difference. It adds up, right? So it's how you categorize your expenses. It's how you define it. All right, and again, the taxes are if it's reasonable and what your intent was. So keep that in mind as you go. All right, let's see. Probate. I can go through this fast. So probate. This is kind of cool. So this is my, and does anyone know where this is at, by the way? Anyone seen this hotel before? What's that? Yeah, so it's in New York. It's the Mohonk Mountain Resort. This is my business partner, Don Pendleton. This is his family's property, or his wife's, rather. His wife's family's property. Pretty killer, huh? I mean, it's one of the top resorts in the country. Beautiful, beautiful, beautiful. And he gets the family discount. It's like $800 a night to stay there, That's beautiful, just gorgeous. So this is his wife's family's estate. And they're the Smiley family, and they actually founded Redlands, California. And I love this story. Well, kind of. I mean, it's an interesting story because there's two parts of the family. Some of the brothers live in New York City, or New York State, right, and founded this resort here in New York. The other brothers came, the Smileys came and founded Redlands, California, right? So they kind of branched off. You know, really worth billions of dollars in today's value. So very, very wealthy family. So what happened was the family got in a dispute, this side of the family. And she's from this side of the family, the California side. And there's, a couple brothers got in this dispute. And when the family, the father passed on, the brothers fought over the estate. So what happens during probate? Lawyers get rich, right? Who makes the money from probate? Right, the lawyers, totally. So what happened was basically after like 15 years of dispute, the attorneys and fighting, no agreement over it. What they could have received, millions and millions of dollars. Each heir received about $5,000 after all was said and done. Seriously. So who made all the money, right? The attorneys. This is a true story from my business partner. This is why he's so passionate about taxes and probate. Crazy stuff. It's just crazy. So again, the California estate was wasted in probate, and the heirs received virtually nothing, right? And a lot of you say, this is common. I have a will. I'm good. All good. I haven't needed to worry about any of this. There's a major difference between a will and a trust. And when we say trust, we say revocable living trust is what it is, right? A living trust. A will, think about this, a will guarantees probate. So if you have a will is basically instructions, to the attorneys, to the courts, probate instructions. That's what a will is. It's a will guarantees probate, right? And it's a matter of public record. So if you think a will is going to help you, make sure your kids know about this, make sure your friends know about this. A will it's archaic now, and a lot of law firms have been using it. It's so cheap, it's $99, set up a will. All right, it's better than nothing for your kids if you have kids, but it's kind of a way for a lot of law firms to drum up business and make money through probate, basically, because they have the will on record at their office, right? You have the will, so they know, hey, shoot, right? When you pass, anything happens, I've got all these wills on file. This is all money. And I'm not saying that, they're being mischievous about it, but that's the honest truth. It makes them a lot of money. So that's why a living trust is so important. A living trust will make it so that you avoid probate 100% in most cases. So will versus trust, there's no comparison. Make sure you're doing a living trust, revocable living trust. And here's a big deal too. If you don't want your estate to go through a public record, a lot of the famous stars will die, and we know how much their estate was worth. We find out, right, when they die, because they had a will. If they had a living trust, we would have known. That's why some you know and some you don't. Like Elvis, we know, right? I forget, but things like that, we know. The definition of will is a formal invitation for your kids to go to court. Yeah. This is a good one. If you like your attorney more than your kids, have a will. If you like your kids more than your attorneys, have a trust. And this is true. So true. It's crazy. Yeah. So remember, we find a lot of times a trust is not just a trust. And again, it's a revocable living trust. A lot of you guys hear about these cool trusts, like in South Dakota. I don't know what he's doing with that one. But anyway, a trust is a trust is a trust. Have any of you guys ever set up a trust before? It's not too bad. Pretty easy, right? If you've done an IRA, that's a trust. According to basically from a legal level, they're all trusts. It's what they are. So trusts are basically all the same thing. And a revocable living trust is very, very different from just a irrevocable trust, right? We don't really do irrevocable, so make sure it's a revocable living trust. Just helps you avoid probate 100%. Yeah, and we find a lot of people who do trusts, by the way, they're not funded properly. That happens a lot. So if you go down to the corner store or corner law firm, or your brother-in-law's an attorney and does a trust periodically for you, be careful. They're done inaccurately a lot. And upon probate, that's a big deal. That'll cost you a lot of money. Make sure they're done right. And make sure there's someone that knows how to do a trust. Yep. So happens a lot. All right. Okay, got it. Yeah, and then a big part of this too, I know Michael covered this, but who's going to care for your kids? There's ancillary documents that go to a trust, right? There's the, medical, zero power of attorney, things like that. Who takes care of the kids? If you have young kids, that's a big deal. Like Michael mentioned, if there are siblings that I have that I'd love to have watch my kids, and probably some you wouldn't, right? Right? So things like that, it matters. You don't want the state making that decision for you. So kids, grandkids, make sure you know how that's working for you guys. All right. Yeah, and we've seen a lot of estates ripped up. You guys probably know someone who's gotten fights over an estate. This avoids that. A will causes a lot of that problem. A living trust, when spelled out and updated correctly, makes it so your siblings won't fight. Sometimes, like we had a story recently that a family hadn't spoken to each other, two brothers, in 20 years because of great-grandma's doily. It meant a lot to them, right? But does it have value? Not really, right? It's not really a monetary value, but the family had emotional value. So we always say, think about the emotional value too, right? Because there's emotional value attached to things you would never know. Ask your kids, ask your grandkids maybe what they might want, right? And put that into your trust. These things do matter. You don't want fighting upon your death. That's the last thing you want. All right, so capital gains. This is interesting. I love this right here. Capital gains I love this comparison. Let's go through this really fast. Does anybody know $1, how many times you double it? So 1 goes to 2, 2 goes to 3, right? Or 3 goes to 4, right? How many times does it double before you make $1 million?
Less than 30 days. It's like 33.
32. 33, 30?
Yeah.
It's crazy to me. This is crazy. 1 to 2, 2 to 4, right? 4 to 8, 16, 32, right? So 10 times $1,000. It's crazy to me, right? So keep going. It just, you think 30, but it doesn't take much. And 20 times $1 million. Is that crazy? So 20 times $1, and so we teach a lot of different events. And it depends on your mindset here, all you guys are real estate investors. Is that possible? Absolutely. Is it possible to take $1 and double it 20 times and make $1 million? Absolutely. If you're a good investor, totally is possible, right? We do a lot of events and people are like, no way, that's not possible. It is. You guys know that, right? So here's the deal though. That's tax-free. That's why you want a self-directed IRA or Roth IRA. Tax-free. Tax-free in, tax-free growth, tax-free out. $1 goes to $1 million after 20 times. Okay, all right, but tax. Let's add some tax into there. Capital gains tax. Here's why capital gains is so bad. Okay, so $1, you pay that 50% tax, and you pay 15 cents. So now, okay, not much a big deal. All right, so is everybody okay with that? You guys okay with paying some tax? No. You guys drive on the roads, don't you?
So we want to pay tax?
Come on. You drive on the roads, right? We have a
gasoline tax.
Yeah, gasoline tax. We have the military, right? We need some protections, right? We do have some social services. As you can argue about that all day, right? But, okay, a little bit of tax, 15%. Okay, what's the deal? All right, so now we go. Not a big deal. Keep going. All right, let's see. So let's add that tax in. How many times here? Okay, so now instead of $1,000, you've only got $469, so half. That's the difference right there. Let's see what happens when we go instead of $1 million. Let's see what it looks like. So keep going, tax, 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 tax. What's the difference here? So the net effect of adding that tax in is you have $1 million versus $220,000. You see the difference of having that 15% tax in there? You don't think it's very much, but at the end of the day, tax-free growth is huge, right? Capital gains, even at 15% mentally, I'm okay with paying taxes, not a big deal, right? If you're not thinking tax-free strategies, you're losing the tax game, for sure. You need to think tax-free as much as possible. That's why Roth IRAs are huge, huge, huge. SEP IRAs, tax-free. because capital gains will destroy it. That to me, when I saw this comparison, $1 million, only 15%, guys, not a big deal, but tax over and over and over on everything you do, every transaction you make, you're going to have a lot less money at the end of the day.
Can you go back one slide?
Go back one. See this one? Yep.
Yeah. So there's your investment, the tax shifting column, or 50% tax column. That's on the what you make minus the amount paid.
Correct. You're probably doing the math in your head. I'm impressed because I'm not that kind of guy.
So a traditional IRA, you wouldn't be getting that 15% every year. You're waiting till you get hit on the end of what you take out.
Yeah, and that's a different equation. Yeah, still. I mean, probably better, but still. I mean, that's why you think tax free. And it's interesting though, because talking to some of our tax pros, like Scott Essel, tax attorney, it's interesting because you do want to have everything as much as possible in a tax free environment, but sometimes it makes sense for you personally to just personally invest and maybe pay taxes on that sometimes too. It's funny to think about that, and that's a very individual, personal tax situation, but he does both personally because he says that favors him tax-wise. So every situation is a little different, but find tax-free environments. All right, so here's the deal. So let's go look at this. So $1 million versus $220,000. Big difference, 15%, guys. All right, long-term effect is you don't grow your wealth, right? Because you're paying taxes, and that is true. Okay, we just covered the 15% capital gains rate, federal. What about the state? Let's add that in. So we have the state in there too? If you're in Indiana, you'd be paying an additional, right, 2.9%. So instead of having, what do we say, $220,000, it goes down to $160,000. So you're paying federal and state on top of it, right? So let's look at Virginia, kind of look at 3.5%, right? Pennsylvania, 3.6%. Ohio, 4.4%. Keep adding those up. Maryland, where do you guys think we're going to end up?
California.
Oh boy, 5.7% New Jersey. And our good friends New York, 6.6%. So $220,000 just federal. Now we're down to $106,000 if you add the state in every time. All right, California, 8%, $91,000. No wonder they're coming to leaving California to move into my state of Utah.
You know what Florida is?
I don't know what Florida is. I think Florida's not. It's not 8%. That's for sure. I think they're between 3 and 4. I think. Yeah, that's true. Yeah. So the long-term effect is you're going to have a lot less money at the end of the day. So speak with Ramez. He knows how to help you get some tax-free environments going on.
True story.
True story. Yeah. Sorry, guys in California. It's rough, I know.
Do you know what Washington is?
I don't know. Yeah, I know Washington's a little higher, though. I think it's 4% or so. I know they're a little higher on the higher side. Yeah. All right, toll roads versus free roads. That's kind of, remember that. As you're doing your taxes, toll roads versus free roads. There's a way to avoid taxes, guys. So any way you can find to avoid taxes will get you $1 million or $160,000, or if in California, $91,000. Kind of sad. So there are a lot of strategies for avoiding capital gains. A lot of you know about 1031 exchanges. That I feel like is a great strategy, but it's kind of kicking the can down the road, right? So it's kind of hard. It's at the end of the day, you're going to pay the taxes somewhere, somehow. Family foundations, living trust, things like that you can go through family foundations. Kind of cool.
Keep talking.
Charitable remainder trust. I know, that would be like a whole other 3-day. So we cover these a little bit in our 3-day asset protection workshop. So if you guys haven't filled that out, fill it out. We'll cover a lot of these strategies. Capital gains is mean. It's just tough. Yeah. Did you have a question, Justin?
1031, if you keep doing it until you die, then it steps up for your kids. So you don't have to pay it.
That's true. Oh, that's true. You're gone. So whatever.
Well, it's tax free for your kids if they sell it right then.
Yeah.
They're trying to change that one.
Yeah. Exactly. Yeah. That was one of the things the Biden campaign brought up. So who knows where it lies? You're right. Yeah. It's true. That's true. You avoid it. That's true. You're gone. The other kids know that.
Is it eliminating the step-up basis just for real estate or across the board?
Across the board generally, but even charitable remainder trusts and family foundations are more expensive to set up It's kind of cool. Again, we'll cover this in our events in detail, but it's actually really neat. It's where you can actually become your own foundation, right? And pay yourself a percentage. You're your own charity. So you're paying yourself like a charity. And that sounds crazy, but you go to those plays or the opening of a new benefit, right? You flip the back over, you see the family foundations all over. Family foundations, the new museum funded by XYZ Foundation. That's what they are. These are tax, basic capital gain avoided strategies. And it's in your own foundation, your family's foundation. And there's reasonable fees and benefits that come out of that. So pretty cool. All right, this is tornado number 4. So lawsuit protection. They did a study at a Pennsylvania university. I forget which one. We always think it's funny. They asked all the students how to make money in life, how to become wealthy in life. All the students interviewed over time. What's the best way, the quickest way to make money in life? Right? Yeah, number 1 was a lottery. They literally said, this is the students' answers. And this is about 5 years ago they did this study. Number 1 was win a lottery. Number 2 was who you marry, right? Marry money. Number 3 was win a lawsuit, right? That's crazy. It's crazy. It's kind of the same thing. And number 4 was inheritance. Number 5 was work hard and get a good job, make some good money. That's crazy because the psyche of that to me, I don't know. So my partner Don was telling me, when he was a kid, nobody sued anybody, right? Unless you got to do something really, really wrong to sue somebody. Now, I go to Las Vegas. It blows my mind. Every billboard is for a law firm. Been in an accident. It is kind of, they've changed the mindset, if you will, to lawsuits are now more the norm to make money, right? You guys hear the stories. And, like Aaron said, he's been sued a couple times. It's not a major thing on his radar, but it's on his radar. If you're an investor, it needs to be on your radar. You got to think of it because, unfortunately, it's just the lawyers win, right? And remember, you can't just blame the lawyers, though, because behind every lawyer is someone hiring the lawyer, right? Not just the lawyers. Somebody's hiring them to do it. So lawsuits are a thing, and the psyche is not what it used to be. Yeah, divorce is a big one. There's something called no-fault divorce, right? Now you don't have to be. There's no fault anymore for divorce anymore, right? So these are major things, major sources of lawsuits. Employee actions are a big one. If you have employees, watch out. That's a big one. Joint ownership, big one too. Think about that. A lot of people, the strategy. And this is kind of archaic now, but the strategy used to be to have the less risky spouse own and hold the assets. So the less risky spouse and hold the assets, the professional other spouse that's high risk, maybe a surgeon or something, right? They would be very high risk, always in a lawsuit. So let my spouse own the assets. Okay, that's very archaic because now very, very easy for someone to tie it back to the other spouse. It just happens very frequently. So that is absolutely not a strategy anymore. There's really not a lot of ways to do that anymore because any attorney worth their salt that really wants to get the assets, it's pretty easy to tie a spouse together. It just is. So big one, spouse is sued, children are sued. They're going to come after you too, after the assets. All right, a suit today for an act 10 years ago. They had a gas station on the property 10 years ago and found, oil was dumped out the backside of and on that land, and you have to do repairs. So they will sue up the chain of ownership until they get that, environmental remediation done. Happens, right? Happens. Not too common, but happens, right? Implied corporate officer. Quick story about this. We had this is again my partner's a relationship of his. They had a dentist that had his wife kind of doing the books and everything. He was working and she was doing the books, but she wasn't an officer of the business. Just would help, bookkeeping, that sort of thing, right? And then one day he went hunting and she had to sign some checks. So she signed some checks because he was out of town hunting. And he came back, and unfortunate things happened, and administered laughing gas or whatever, and the child basically didn't make it. Had a reaction and died. And so they sued the dentist, and they had put everything in the spouse's name because it was less risky. But do officers sign checks?
Yeah.
Yes. She was then an implied officer of the business because she had signed those checks. She became that officer of the business. So that's all it took, was to have her sign a check.
If she had a title like bookkeeper or something as a business employee,
Yeah.
would that have to solve that problem?
Possibly. Yeah, that's tricky.
Check writing rights, I guess.
Yeah. Power of attorney, things like that. It's tricky because it's still a spouse, and even more so now with the spouse, they just tie assets together. Community property states, things like that. It's crazy. It's a lot easier now. But yeah, so just keep an eye on how you do things. It does matter how you do the business. I'm not trying to fear tactics. It's a reality, though. It really is a reality. It's the sad truth. So keep good records. Keep in mind on how you run your business, because at the end of the day, it does matter. All right, and remember, a lot of you think insurance will cover you. We hear that all the time. How big is the book of exclusions on your insurance policy? How big is what they cover? Right? Remember that? There's a lot of exclusions. So we don't rely on insurance alone. That's just definitely not something we do. When it comes to insurance, should you have insurance? If you have an LLC, you're totally protected. Should you have insurance?
Yes.
Okay, you should, because if you have a slip and fall on your property, someone legitimately breaks a leg, right? You want to have insurance to cover that. That's reasonable, right? Should you have a $5 million umbrella policy on every property? You think?
No. On every property?
Yeah. Should you have a massive umbrella policy on every property? You think? Versus, it's kind of tricky, because a lot of times you think I should have a major insurance policy to cover my butt in case something happens, right?
It makes the target bigger, right?
Totally. It makes you a bigger target. So think about it this way. If someone wants to come after you and you got someone rear-ending you or whatever, right? Causing you to rear-end them, right? And are they going to sue someone who has a very nice legal structure, LLCs, everything locked up away, or someone who has it on their own name but has a massive $5 million umbrella policy? Which one, if you're the attorney, which one would you sue? Yeah, because insurance companies settle a lot. That's why it's so expensive.
So where is the place for an umbrella policy then?
Yeah, so that's good. What balance? It really has to be, like Aaron said, he doesn't go for the most expensive, crazy, out of whack one, but he also still does have insurance, right? He still does. So it's a balance. You got to find a good balance for you that you're comfortable with. I don't know. Don't go for the massive
So at that
policies.
point, is it an umbrella over the business, or is it umbrella over personal?
Usually it's umbrella over the business generally, and then that's just for errors, omissions, things like that, whatever. But don't overdo it. Don't make yourself a target. That's basically what it comes down to. Don't overdo it. All right. Source of lawsuits. So as a real estate investor, here's your source of lawsuits. So tenant safety and welfare. This is 56% of the real estate lawsuits that happen come from tenant safety and welfare. Big one. So if you've got an attractive nuisance on the property, if you don't have lights on the property, things like that. If there's something that you should fix and haven't done it, careful. Sexual assault, wrongful death, robbery. That's 56% of it. So be careful on that. We covered some of those other ones. Yeah. This is a good example of, we think offense, invest, buy real estate, buy stocks. That's all we think about, right? But at the end of the day, a good football team doesn't win a game unless they have good defense too, right? It's true. True in life too. A good offense is fun and flashy, and that's what we always think about. But a defense you're not going to win the game unless you have a good defense plan too. So always make sure you're running defense at the same time. Think about it like a game. All right, so we covered insurance a little bit and legal structuring. So what's the best legal structure for real estate investors?
Yes.
Yes, it depends, right? So it depends. And it really does depend. If you want to hold the property, do you want to flip the property, right? You hold the title or the note, right? So It really depends. And it really comes down to you and your partners, your family. There's so many things. We can't make a blanket statement and say everybody has to have an LLC, right? You just can't say that. Everyone needs a corporation. We do think everybody should have a business because there's tax benefits. But as far as holding the asset, frankly, it comes down to even a very much state level and sometimes county level. Because remember, what really matters, the strength of your entity, your LLC limited partnership, comes down to case law and court history. Remember, several years ago, we only did limited partnerships or family limited partnerships. So even 10 years ago, we didn't do LLCs a ton. That wasn't the thing because limited partnerships are over 100 years old. They have 100 years of court history backing it up. And that's where the strength of your entities come from, is from the laws that are on the books in America. That's where it comes from, right? So 100 years backing it up. It's pretty strong. 1970s, Wyoming passed the LLCs, right? And that's why they're so popular now, is because now more states have adopted LLCs. And so now it depends on the state, frankly. You know, sometimes, like in Florida, we do limited partnerships over LLCs because of the cost difference. And then, like Pennsylvania, you know, we don't do a lot of limited partnerships. It's only LLCs because the laws are so much better for limited partnerships versus LLCs. Every state has different laws on the books now, and that court history shows LLCs might be better than a limited partnership. So it's very specific. That's why I talk to Anderson, whoever you're using. It's going to vary from state to state. All right. Yeah, so you hold it or flip it. These are your concerns there. Concerns are very different if you're holding the property versus flipping it. These are just our structuring, from a structuring side. Yeah, if you hold it, the concerns are different long term. If you flip it, you're dealing with contractors. So think about the differences if you're flipping properties. Yep, strategies are very different. All right, so let's talk quickly about corporate veil. I'll just go through this quickly since Michael covered this a couple days ago. So basically what happens in the corporate veil, this is like a corporation. You have a brick wall. There's a brick wall there in the middle. And the brick wall protects the business from you. That's how that works, right? You have a lawsuit against the business, right? And the goal is to shield the officers, directors, contain and attract the risk. And then that's where it's protecting you or the business from you, okay? So that's corporations and LLCs. Now, if you have a charging order protection, that's going to be generally LLCs, not a corporation. So the difference is, right, you have a lawsuit coming against you, it's going to protect the assets, the business and personal assets, you know, separate them out individually. That's where a charging order comes in. That's LLCs, limited partnerships. And the goal here is to protect the business and personal assets from you. That make sense? So business lawsuits versus personal lawsuits, it's really to give you some legal separation. All right, and this is a big one too. The strength of your LLC is determined by the number of owners. Aaron covered this very quickly. If you have one person in your LLC, the likelihood of that ever going through a lawsuit and being ripped open is high in most states. Because a single member LLC, there's no innocent parties. And basically the case law says there has to be innocent parties to uphold the strength of the case law. So you want to have multi-members. And if you're just single, you don't have anybody that, you know, you don't want to partner with, no spouse or anything, a corporation does that. You can make a corporation a partner in the lawsuit, or excuse me, in the entity. Not in a lawsuit, over that. Yeah, so again, the strength is determined by the state, the strength of your agreement. Anderson has a great agreement in maintaining your entities. All right, so we go through the cases. Here's a big one. So a lot of you guys are using single-member LLCs because there's no tax return. So it's kind of nice because single-member LLCs, they're disregarded entities according to the IRS, right? No tax return. Awesome. That's why everyone likes to use single-member LLCs. But think about it this way from a legal standpoint. If the IRS disregards the entity, is it likely the courts will disregard the entity too? Yeah, it is. That's why in most states, according to these cases, the cases that showed why, Single member LLCs are not as strong as multi-member LLCs, and in most states we don't use them, right? So in 2010, Wyoming created statutes. Nevada, Delaware, South Dakota, Alaska actually have good statutes now. So in those states, you can use a single member LLC.
Okay, I'm a little confused. If you have a husband and wife,
Yeah.
they own the LLC 50-50.
Yeah.
Is that multi-member
It is.
or is it single member?
Multi-member.
But it can also be single member, can it? Can it be disregarded?
No, not if there's two people in it.
Hang on. In Wyoming, because I just did this with Anderson, a husband and wife can be considered a single member.
Because it's community property state.
And that, and so it's disregarded because of that.
That's true. So in community property states, husband and wife can be as one. That's true. Community properties like Washington, Oregon, California, Texas, I forget the other ones, but those are community property, which means spouses are as one according to the laws in the books there.
Right.
That's true. That is true.
So then your LLC doesn't protect you in any way?
That's why you got to set it up a little differently, right? And that's why we use Wyoming. Wyoming's a great one. That's true. That's kind of
It's
a newer
the
thing.
answer. It depends.
Yeah, it depends. I know it's confusing. Sorry, but it is. I know.
So
We just don't use. If you define it as a single member LLC, if it's defined as a single member LLC, basically, when you set it up, then it's not very strong. And even like you said, I know it's confusing. Basically, you want to have multiple members, and sometimes because husband and wife now, this is kind of newer, they're considered as one. Then you want to have a corporation come in as a partner too. Does that make sense?
So
Then you have multiple members, as many members as possible.
Because we actually have two. We have one that is multi-member, the two of us, and
Good.
we have an LLC that's a 401k.
Nice.
And it's a single. It's considered.
In what state?
Florida.
Okay. Is that with Anderson?
No.
Okay. Yeah, it depends. It really depends, and I have to look at it, to see how it was set up. It really depends on your agreements, and even then, now basically they're trying to come back against them now and make them community property states as one, so they're single member. You know what I mean? So they're not strong. All these cases, the Albright case and things like that, it made them so that they're not as strong. They're trying to open those up, you know what I mean, from a legal standpoint. But as long as you have a good agreement in there, it's a multi-member LLC, you're probably fine. Yeah,
Well,
sorry.
I believe that our multi-member is still disregarded.
Is it?
Right. And it's held by Wyoming, so, but we get, the taxes come to our personal
Okay, so it's passed through. Good.
pass through. Okay,
Okay.
so that's different than disregarded?
No,
I got
It depends.
I'm confused.
Your partnership with you.
Oh, okay.
Yeah,
Okay.
most likely. For the most part, multi-member LLCs are stronger when you set them up with the agreements. Single-member LLCs are not, unless you're in Nevada, Delaware, South Dakota, or Alaska. They've adopted statutes to make a single-member LLC stronger. That makes sense. I know, it's confusing. It is. It just depends on how you did it, right? That's basically what it comes down to. Good?
Yeah.
Okay. All right, yep. Depends on the state. Every state, these are kind of examples of the states. 5 stars in blue are very strong. Red stars, surprisingly, California is on there. 1 star for both LLCs and limited partnerships. So every state's different. We kind of go through some of these at our summit. All right. So this is an operating agreement, kind of like we have a special, unique drafted operating agreement. Anderson has a special, uniquely drafted operating agreement. You want to put all these, this is where your strength comes from, is your agreement. The agreements are really, when you set up an LLC and you file with your state, you think you're good, right? The thing is, you actually set up the agreement, right, with your own personal records. And you don't actually file, in most states, you don't file that agreement with the state. But where the rubber hits the road from a legal standpoint, if you're ever in a lawsuit or an audit, for your tax benefits or things like that, your agreement is where the rubber hits the road. That's where you're paying the big bucks for an LLC. You can go file one for $100 online today. You can. And LLCs are cheap. But you get what you pay for. And this is where you want to have a good group that does a very, very strong agreement. All LLCs are not created equal because of the agreement. The language in these agreements, our agreement, Anderson's agreement, are very, very different, and they're court tested. So kind of cool. Anderson's is huge. If any of you guys have set up an agreement with Anderson, it's like a binder. And they want to go thud on the desk. They want it to be strong. Because most attorneys don't want to read that, oh, okay, well, I'm backing off this lawsuit. You know? It's a good thing. It's a good thing. It's a tactic.
So, without getting into all the nuances, what in the operating agreement does make it so strong as compared with, let's say, a internet-based create your own
So
LLC?
one example is distribution of assets, right? So a lot of them, the paper, just run-of-the-mill type LLCs is you have distribution of assets. So it basically says at least annually the LLC members will receive distribution X of assets, right? Percentage of assets or whatever. If you get in a lawsuit and you lose, you have to distribute your assets at least annually to whoever won the lawsuit. You got to distribute your assets. You don't want that, right? So they add in clauses like, you know, the partners will distribute assets at least annually unless voted on by the partnerships. It's something as simple as that, right? So you decide, if you get in a lawsuit, well, I vote to change that so we don't distribute assets anymore, right? And you want to have voting rights, things like that added in. And there's another one's tax benefits too. If you don't have your medical stuff in there, detailed in there, a lot of them, it matters, really the language of it. A little bit of idea there. All right. Okay. Yeah.
I also heard having like a checking account where your business running the funds through it, showing accounting, that you're doing business as a business.
Totally. If you're not taking your business seriously, they won't either. That's totally true.
Okay.
Yeah. And that's why you want to have a bank account for each entity.
Right.
When possible, totally do that. You want to show transactions. You want to show you're treating it seriously. You want to take that cruise and do your meetings and minutes, resolutions, right? A lot of you think because an LLC is simpler, you don't have to do meetings, minutes, and resolutions, right? You think, oh, well, that's fine. I don't have to. We still recommend it because then it's just stronger, right? So
if you don't have any ins and outs in a bank account from a holding company, though, how's that going to work?
You mean as far
really,
transfer?
Say you have a holding company, why am we holding company like we do? Mm-hmm. There are no ins and outs up there, right? It's more at the LLC level, or
you should have a bank account. You should go back and forth.
There's a bank account, but the money train is from the LLC to the bank account that's attached to the LLC.
For the property? Yeah, you should generally how you do it. So we look at it this way. That LLC, that's the corporation or LLC, there's the management entity. It manages everything. And from an asset protection standpoint, if you've got 15 properties here and their own separate LLCs, right, you want to have the management company receive the rents if you're doing it on your own, right? If you have Alpine do it, it's easy, But if you have the management company receive the rents, well, then it's not going to you. You're not going over there and collecting the rent, or XYZ LLC that owns the asset. You want to keep it totally separate and collect the rent in that management entity. It all goes there and distribute from there. Does that make sense? Yeah. So that's kind of how you do it. Keep it separate. All right. Yep. So maintain your entities. Keep an eye. Business licenses if you need it. Advertising, proper funding. Just keep it tight, right? Okay, let's kind of go through some entities really fast. Again, this is kind of how we do it. You always have a management company, and that can be a corporation sometimes or an LLC, and it just depends on your personal tax situation. This varies from person to person what you're going to use. So LLC tax is a corporation. A lot of people still don't know you can have an LLC taxed as an S or a C corporation. So a lot of people don't know that. It comes down to your personal tax, whether it's a pure corp or an LLC. All right, so a management company, and then you have a safe asset FLP that holds the property, or holds the assets, bank accounts, cash, whatever, then a living trust. This is a basic structure, very, very basic. Everyone should have a business. Everybody should have a living trust. And if you have assets, hold them in an FLP or LLC. That FLP there in the middle could also be an LLC, depending on your state. Yep. Management company, everything goes down. Everything ties into the revocable living trust. Ultimately, make sure it all ties back to your trust. If anything happens to you, all the income, all the assets ties to your trust. Yep. All right. So then if you have safe assets, FLPs, you've audited some properties, multi-member LLCs, this is where you start to divide things out. We had a doctor in Utah that had 45 properties and he had 45 LLCs. That was overkill. Remember, you have a tax return for each one, right? It's overkill. So don't do that. Don't go overboard. But Aaron said what he does is he has $250,000 of equity in each bubble, LLC, if you will, before he divides them out. Now, if you've got $1 million property, that should be in its own, right? It really comes down to your risk. Maybe it's $50,000. Maybe it's $100,000. Maybe it's $250,000. That's Aaron's threshold. You know, if you have a high risk property, put it by itself. So you can put 3 in 1, 2 in 1. Remember, every property that's together in one bubble, if something happens with one property, it could potentially tie the other properties in that bubble in a lawsuit. So just keep that in mind. Yep. Good. All right. Yeah, so this is kind of cool. So this is where the multi-member LLC versus single-member LLC comes into play. How many tax returns are on this? If this was you guys, if this is your tax, how many tax returns are here?
One.
Yeah, so technically you got the management company, right? And you have the multi-member LLC. So it's really 2, right? And then 1040. So there's 3, right? Technically 3, right? But that's nice because if you did this last example, we've got 1, 2, 3, 4, right? If you want to make it simpler, here's why we do it. Remember we said the single member LLCs weren't as strong? Well, you can layer it with a multi-member LLC. So kind of a creative strategy. That's a lot of what Anderson does. So that's probably where the protection might come in from. Kind of cool. And less tax returns. As long as you're layering that single member LLC and creating more divisions, kind of makes it nice.
So is the single member of that LLC the multi-member LLC?
Yeah. So you just, basically the multi-member LLC owns the single member LLC.
Right, okay.
Yeah.
And that's a disregarded
Yeah.
entity? Okay.
Yeah.
Yep.
Kind of cool. I don't know. A lot of law firms are guessing that the single member LLCs will eventually no longer be disregarded, but we'll see. That's my bet. I bet. Give it a few years.
You could have one corporation
Yeah.
and be multi-member of all of them.
Yeah, because that multi-member is owning the single member LLC.
So
That makes sense? Because you have the protection here that protects these. That makes that just stronger because these by themselves are not strong. But if you have a layer of protection there, it makes it strong.
So that one doesn't combine all of them.
This does, into here, the asset. The actual assets are for this one, and this just manages.
Okay.
Yeah, by the way, the management company never owns any assets. Like if you put real estate in the management company, that's a big no-no, right? Big no-no. Make sure that your management company does not own anything unless it's computers or equipment, right? Keep it simple. Don't own assets there because if you're in a lawsuit, you're collecting rent for all these properties, that's where they're going to go. They're going to sue that first. All right, so finding the money, that's kind of cool. So we talked about, there's a lot of ways to fund real estate investments, right? And a lot of times it's your business. Yeah, you guys got this. So if you're finding the money to manage your investments, oops, sorry guys, go back there. You have a multi-member LLC that can funnel to your IRA, right? You can funnel to your health savings account. You can funnel to C Corp to invest in more assets or other business ventures. Yeah.
For the multi-member LLC, I heard you guys talking about C Corp with like myself. Is there any advantage to that over myself with my wife?
For sure. Yeah. Yeah. Generally, even in a corporation, the strength always is better with more.
There's more safety with having the C Corp.
Yeah, because a judge will look at innocent parties. Are there innocent parties involved in this? And that's why even with corporations, you want to have multi-members. So it is better. Where possible.
So going back to the last slide, where the multi-member LLC holding the single members, like Aaron was saying, he only owns for his limit is $250,000.
Yeah.
That each single member LLC and the multi-member is holding $1 million of assets.
Well, it's holding the single member LLC. It's not holding technically, it's not holding it, right?
Right.
Yeah, that's the idea.
So then the single member is where the 250 limit is sitting, right? And then the multi-member has control of each $250,000 single member LLC.
Correct. And the idea is if you're sued, right, they're going to say, oh, okay, well, there's a chain. Okay, so you're sued here, and it goes here, right? And then ultimately, if it gets looks bad, you can change these. Boom, pop them out, right? Pop them out to different entities so that they're separated. Boom, 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 boom. And then they won't tie that all together. That's the idea.
Yeah, right. It's really easy to do that.
Yeah, it's real easy. Yeah, it really is. These are interchangeable. Unless everything, don't be afraid to do these because they're changeable. You can change an LLC fairly easy. It's not hard to do. Corporations can change. The only thing you can't change is an irrevocable living trust. It's irrevocable. It's concrete. Don't do irrevocable trusts. They're good asset protection tools if you got something you know will be in the family for hundreds of years, but that's the only time. Yeah, good.
Live in that pain right now.
All right. Okay. So here's the cool part. IRAs. We don't need a management company because it's tax-free, right? There's no reason to do it, right? I mean, that's why if you're using Alpine and you manage your IRA, it's pretty clean, pretty easy. You don't need a revocable living trust because an IRA passed your heirs, right? You're avoiding probate. You're avoiding capital gains. You're avoiding all that. That's why IRAs, again, we come back to IRAs, great asset protection tool and great tax tool. All right. Self-directed IRA. Yeah, you can have as many IRAs as you want, right? IRAs can own and break out into single-member LLCs. We have multiple IRAs here owning multiple properties. You can have more than one. It's kind of cool. So you have multiple IRAs owning multiple properties. Talk to IRA Club about that. Kind of cool. So if you don't want to do LLCs, you can do it this way, IRA owning LLCs, or you can do it this way. You can own IRAs owning the properties. So if you got a lot of money or tax-free growth, do it. It's a great way to go. All right. Good timing, Aaron. That's perfect. Yeah. That's perfect. Yeah, so we didn't have time today. So at our events, if you need to fill out this card, I've got the card here for you.
Does anybody need one?
Need to turn mine in.
Wait, does everybody need to turn it in?
Okay, turn it in, and I'll pass it around to you. But yeah, so we cover a lot of this at our events in detail. Aaron doesn't sing at our events, but maybe we should plan that sometime.
Yeah, definitely.
Dang it, no piano.
No, there's our singer right there, man.
I don't know who you look at.
Everyone down there. There's my fingers. I don't know like 15 songs.
But fill it out. We kind of, if you've been through Anderson, Clint comes and teaches too, but we have kind of a different approach. We have a lot of different things. ProtectWealth.com, we have our agenda. Fill it out, get it back to me, and we'll get you guys registered. Thanks so much.
Thanks, Ken. All right, we got 45 minutes. If you didn't get a lunch, make sure you grab one. The cronuts are here. Does anybody have one?
Yep.
Those twists and croissant there. Yeah. Thanks, dude.
Sure.
That's right, fala.
Did you guys talk about the intersection in these dates?
Which dates?
This is very close to the
Indy?
your live event here.
Is it?
Which one? Which one? February?
February 20.
I thought they were. I thought I heard
24.
Yeah, because we're February 19th through the 21st, and yours is
okay. So it happened
right after. Yeah, we usually don't overlap.
We try not to, but
But it's is that a live one in February? Or it's TBD. Yeah, there's no way, Anna.
It's gonna be live stream.
Yeah.
Yeah, live stream.
All right,
we're good.
Okay, any other questions for me about anything we've covered all weekend? Good. All right, I'm gonna show you guys one last video. Trace, if you want to stop the feed. I'm gonna show you my I don't want to work out video. in competition poker until I learned to disconnect that the chips had any value. Because I noticed when I played at my little weekly poker game with my friends, where the buy-in was $20, I was a better poker player. And so I said to myself, I have to get to where even when I've paid $10,000 to get into this tournament, I still play as if the chips are worthless. I still play as if it doesn't matter. Doesn't mean that I take more risk. It just means I disconnect from the emotion of the money so that I can focus on playing excellent competition poker. Because if you still in the back of your mind care about losing the money, then you can't take the risk that you need to when you need to take it, and you can't be conservative when you need to be. And then one of the other reasons why I have such a secure floor with my money, think about how easy it is for me to take risk in my business on deals or on projects. I could, because it made it so, like, for example, in the modular mobile home space, I was easily able to afford to lose money on the P&L in Kansas City or on that apartment complex that I showed you yesterday without any heartburn. Because I'm not saying, gosh, if I have to rewire that 17-unit apartment complex, that's going to make it so that we can't go on vacation this year. And so it actually allows me to take more risk at the auction with my business, to be only focused on the balance sheet with my properties or with a new project. You know, I think of, like, when we set up the modular home dealership in Idaho, my focus was we started a year and a half ago. I never even thought about what kind of profit we were going to make last year. I don't think about how much profit we're going to make this year. I'm only focused on the process. What's the very next step for us to grow this brokerage so that we have an abundance of business? So right now I'm trying to recruit a mortgage broker who's willing to learn how to do chattel loans, which are the personal property loans you use on manufactured homes that aren't on permanent foundations. Like, it's that specific. Because I know if I get that lender in-house, then there's a whole book of business that I'll be able to capture, which will then translate into more money, which is why I'm paying $750 a week for Jake to live in Kansas City right now and learn how to move and set homes, so that when I move him to Pocatello in the spring, that's another major piece that will click into place. But I'm not worried about the fact that my P&L in October sucks. Who cares? You know, some of you have a 100-acre field, and you're so proud of the half acre that you plant. And just because it's in your backyard doesn't mean that it's really that much to be proud of. And that's what you do when you obsess about the P&L over the balance sheet. You're missing out on all the big money, which is to plant all 100 acres. And if you're stressing about your bills, you can never have the patience needed to do that. Next to my housing, so the Megan's McMansion that we're buying, can I call it that? Yes. Right? There's a Christmas tree farm. And that Christmas tree farm has been there for 40 years. And every spring, you see that little row of saplings that they've replanted. And it's like 50 acres. And every November, another row eliminates. They let it sit for a couple of years, and then you see that replant. But they'll never not have trees again. They're gonna crush December. I was talking to the farmer. He's like, "Yeah, we make like $300,000-$400,000 every December." Right? And now, you know, I love that my dad set it up, because now all I got to do is do 200. He's like, you know how long it takes me to plant 200 trees? It's like 3 days. He's like, I really work 3 days a year, because then my kids sit on the lot and sell trees. Right? And it's so easy to maintain. Now, in Good to Great, they talk about a flywheel, right? A massive flywheel. And how with your business, it's so hard to move it an inch. But then once you get that thing going, and then once it's momentum and it's spinning, it's so easy to keep it going, right? And this business for us has turned into a flywheel. For me, you know, Brittany's so good about acquisitions. Travis is so good about bringing deals. I don't even think about who buys what or if we sell any deals, because Meg and her team handle that. And you know, every week I'm spot checking KPIs, because I think every employee needs a KPI, key progress indicators, or a metric to help define their productivity. And I think every employee should have to self-report those every week. That's part of having good systems across markets. But we have a flywheel that we put in place that's making me hundreds of thousands of dollars every month. And Meg's like, why are you still pressing so hard? Because I really love competition. I like in a weird way, Meg's like, just sell those parks in Kansas City. We got like $2 million. I'm like, no. If we sell those parks, that's like a loss. The points on the volleyball scoreboard for the freshman Pomona Valley Wildcats were meaningless in the universe. But I lived and died for those for 4 years. I spent hours thinking about those. And like I said yesterday, the only good money is the first check. This is so not about money for me, and it's 100% about just winning. Because I'm still as competitive at the $20 poker game. And I've learned to be gracious when I lose, and I've learned to say, hey, nice hand, congratulations. But I had to leave last week because this guy was like, yes! Because I had a full house and he had a straight flush. And I knew that was the only hand that could beat me. I'm like, all right, I got to see your straight flush. And he had it. And I was like, nice hand. He's like, yes! And I wanted to punch him in his face. And I was like, all right, guys, I'm done. And they're like, yeah, we'll be in 2 hours. And I'm like, nope. Because if I'm done, I'll be a dick. And at 47, I'm not trying to be. I'm a grown-ass man. I'm not trying to act without class. I don't like when I get angry. And so, yes, I still always hate losing more than I like winning, but I've learned to channel that. And so now, you know, here's what's interesting. You still feel uncertainty and fear. You know, when I left the high school, I remember thinking, ooh, am I screwing it up? Did I just get lucky in real estate? Was it just cavalier and foolish for me to walk away? I'm a year away from my pension. You know, it's been 20 years. My first year teaching was 2000. This year, I would have hit my $8,000 a month pension qualification, right? I probably could have just won my 15th state soccer title, right? 12th volleyball championship. And I always think about that alternate path. Not with regret, but just thinking, because every decision that we make has an opportunity cost to it. And it's important that we remember that. But what I'll never regret is making that decision to put my 2 little boys first, to move to Idaho and to raise them, because it's been phenomenal and they're thriving. And it's a privilege to be their father. It's a privilege to be part of this journey with them. And so that's filled my family bucket almost to the top. But and I don't know if it'll ever be full, but just like I don't think I'll ever have a 6-pack, so I'll probably never have a full fitness bucket either. But I can tell you that I feel balance in my life and I feel happiness. And maybe part of your motivation for coming this weekend was to get the money, get your finance bucket a little more full. But as a teacher, I have to tell you that my finance bucket's been overflowing for 10 years, and it's actually been the other buckets that have brought me a happiness, a balance, and a clarity. It was running my first marathon a year and a half ago, all 26.2. And I was 254 pounds that day. I thought it was the Grand Teton Marathon, and at the end I was like, dude, I beat like 50 people. And Fred's like, no, DNF means did not finish. I was like, oh, I beat one person. And he's like, well, you were the number 1 in the Clydesdale division. I was like, what did that mean? He's like, well, anybody over 225 was Clydesdale. And I was like, well, I was the only person over 225. He's like, you won. and I just didn't want to walk, right? So I was going like 4 miles an hour by the end, because it really hurt, man. I had torn all the perineal tendons in my foot by the end, and I was like, I don't want to say I walked a marathon. Anybody go, well, I wanted to jog. I wanted to jog a marathon. And it took me 5 hours, right? I averaged 5 miles an hour, 5 hours. And Fred said, hey, you should pass one person, because he was running with me. And Colonel Fred's run, 30 marathons. And he's done the 24-hour marathon where you run 100 miles. So he averages 4 miles an hour for 24 hours. And I was like, okay. He's like, see that lady, let's pass her. So I go from on the treadmill, I was averaging 4 miles. So I click up to 4.2 miles an hour. Right? For most of you, it's a fast walk. And I'm reeling her in. I literally passed her with maybe 200 yards to go. And it was a rush to actually pass someone. I wanted to check her in the face. That's why, because that was one win. I had one win that day, right? And I found out later she's 78. and the last bathroom stop at mile 23, mile 24 was 2 miles before the end. They had these blue porta potties and Idaho, everyone's nice in Idaho, and it was all the students from BYU Idaho, all these cute little Mormon kids, and they're like, yay, come in! And I'm coming into the bathroom, and they're handing me Gatorade like I'm a legit athlete, and so then I go in the bathroom. I'm like, Fred, I gotta pee. He's like, okay. And I gotta tell you, man, I wanted to sit down so bad and just take a nap. And all of a sudden, Colonel Fred, I see his face at the little holes of the porta potty. He's like, "Don't you sit down, bitch!" He's like, "I know you want to sit down, pee, and that's it." And so I'm like, "Ugh!" So I just pee all over the walls of the porta potty. My middle finger to Colonel Fred. Go out, and everyone was at the finish line, and pretty cool to come down that last stretch and to cross the finish line, even though I was dead last. Well, second one old lady. She hadn't even no one there because it was her 80th marathon in 20 years. And that was one of my biggest days. That was one of my biggest wins. And whether it's seeing one of my employees get their self-directed IRA for the first time in their life, or watching Buster and Carmen finally have health insurance, or watching Brittany make her first $1 million, I've had a front row seat to that. And that's the color to a life well lived. That's the texture to a life well lived. What you do for others, the impact that you have on them. And as I plugged into that, people say, well, why don't you just sell it and everything? What would I do? Well, what I do is so amazing right now. So I'm so grateful that you came this weekend, that you had a chance to see what we put together. I do think what we have is unmatched, and there isn't another organization like it. For some of you, you bought properties. I'm excited for that. We're going to take care of you. You have my cell phone number. You have my personal email. And for some of you, it wasn't quite the right time, but now you know who we are, and we know who you are, and I'm sure we'll connect down the road. And that happens all the time. And some of you, maybe we're not a great fit for you right now, but someone else in your life is, and work with Meg on that. Let's get them out here. But we'd love to see you come back. We'd love to have you join us again. As you can tell, it's never the same event. What we cover is always different every month. I think we're going to do, Anderson wants to do 12 of these next year. I've never done 12. I usually do 9. But we usually take May, August, and December off. So they're talking about doing May, August, and December because they have so many. Nobody's doing what Anderson does. They really are the biggest and the best asset protection firm in the country, law firm. So look forward to having you guys come back. Just hit our team up for anything going forward. And it's been a good weekend. Thanks, guys.
Thank you.
Yep.